Good to see you. Hey Paula, hey Jeremy. Hey Rita, my advisor's name was Rita, so every time I say the name, I do this with utmost respect. Hey Giovanni, hey Jolanda, hey Fatim. You know, one thing which is funny about this, when I started doing these webinars, I talked with the INSEAD event service, and I said, like, look, I'm going to do something like on venture capital. How many participants do you think can I expect? And they said, like, well, overall, probably like 400 or 500. And I was like, okay, so I'm going to kind of do 10 sessions because my typical class size is like 40, 50, and so that's like the thing to deal with. And so by now I had more than 10,000 participants. I think today we could hit 11,000. And to me that's always funny because I teach a class on scaling, and I tell the students sometimes you scale faster than you expect yourself. But of course, because I teach it, I kind of assume that I'm immune to it, right? I would see it coming, of course, because I teach that stuff. And so here I am, right, kind of expecting to teach webinars for like 500 people, and now I'm like at number 10,000. But it's, look, the very idea was to kind of get the knowledge out, so I'm very excited actually that it has worked out. Let me share my slides with you so that we're getting started. I also see one or two of my colleagues that's particularly intimidating, but this should get every one of you like a good feeling. If even my colleagues sign up, it's probably an indicator it's somewhat okay. Having said this, they haven't seen it before, so. Alright, so it's 11:03. Let's get started. We can kind of, as people kind of, if more people sign up, we just kind of read them slowly. Alright? Just like one more thing to set up here. Okay. Alright. So welcome to the workshop. We're going to talk about investors, particular venture capital business angels today. Okay. Before we kind of get into the middle of all of this, I thought I'd give you a short background on myself. So my name is Henning Piezunka. I live in Paris. This is not my apartment, but this is the kind of apartment I'm living in. This is the Fontainebleau campus. This is the place where I normally work. It's kind of beautiful vibrancy. These days with a lot of kind of security controls. We're still doing like in-person teaching at INSEAD, so that everybody's secure, everybody's wearing a mask, and we're doing regular COVID tests. But it continues to have this very kind of nice entrepreneurial spirit and vibrancy. So I'm always kind of energized going there. I'm originally from Germany, as you might have already heard from the accent. I'm specifically from Heidelberg. Fun fact about Germany, there is no fun in Germany, so we can all go back to work now. There's a different way of telling this joke. What is the meaning behind the colors of the German flag? The black, the red, and the gold stands for work, and the blue stands for humor. All right? This, by the way, is about the same kind of response I get on jokes when I tell them in the classroom. There's absolutely dead silence, okay? So what you can actually do to make this a little bit more fun and entertaining, if I say something you think is funny, you can type LOL or ha 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 into the chat room. I would say what has happened in the past is that people then wrote LOL when I did not try to make a joke, but that's then kind of funny in its own way, okay? So we'll see how this goes. Briefly talking my background, so I'm an assistant professor at INSEAD. I've been at INSEAD since 2014, so it's my 7th year. Before this, I studied at the University of Mannheim, Germany. I was an exchange student at the CSO. I got a master's degree from the London School of Economics, and I got a PhD from Stanford University with a particular focus on entrepreneurship. So before joining academia, I had created a web design company, which I ended up selling in 2016. With a bit more than 25 employees. It's not the kind of company we talk about today because we are much more talking about high growth companies. But you see, I've tried quite a few of these things actually in practice. Yeah, and I very much kind of teach this material for PhDs, MBAs, executives. I work quite a bit with corporations. I don't teach it to undergrads anymore because at INSEAD we don't have an undergrad program. We have a fantastic MBA program, Masters in Management, but no undergrad program. Okay. A short note, I will at some point put together like a community, so there's no need for all of you to share your LinkedIn profile. It's not very effective, and it takes everyone's attention away. So think about this: every time you post your LinkedIn profile, you take the attention from 240 people, but nobody has time to look at it. Okay. So please don't share your LinkedIn profile. I'm going to create a community where you can interact with one another if you want to. All right. When I'm not teaching, when I'm not doing research, this is pretty much the centerpiece of my life. This is Hector on the right-hand side. He's in school now, and if there's no COVID case or so, I actually also have 3 hours where I don't need to run anywhere. Okay? So here's the biggest question. You're going to take 3 hours out of your morning, and so the key question is obviously, how do you get the most out of this class? And I really want you to squeeze out this class like a lemon, okay? The very idea is that you get the very most out of it. And I would like to point you to 4 types of learning, okay? And these 4 types of learning apply to today's webinar, but I would say they apply basically to any kind of webinar or to any kind of learning for that matter, okay? So, the first thing I want you to do is I want you to steal as much as possible. And what I mean by stealing is you can just take something I talked about and just lift it and use it somewhere else. So let me give you an example. After this call is over and you go to a colleague and say, hey, you know what the blue in the German flag stands for? Humor, okay? And you suddenly sound funnier than you actually are. And guess what? I stole that joke myself, okay? So the more stuff you can steal, the better, because the more you will remember. The second category is inspiration. So what we talk about is useful to you, but requires some work or some tweaking, right? You might say like, okay, that's a concept which is relevant and I can use this with an investor in like 3 months from now, and this is how I'm going to put this in the slide. So you know why it's useful, and then you kind of run with it.
Not so loud.
The next category is what I call an oyster. And an oyster, as you can see on the slide at the right bottom, can actually become a beautiful pearl. But the interesting thing about it is you do not always yet know which oyster becomes a pearl and what kind of pearl, okay? And so the way to think about this is what we discuss is interesting to you, but you do not yet know whether and how it will be useful. And let me give you an example for this. When I was like 15, 16 years old, I became obsessed with Formula One. I started watching every race, I collected every article, and so on and so on. And it was incredibly interesting to me, but there was no use case for it whatsoever. There was absolutely no use. But 20 years later, I wanted to study high-performing organization. And what greater area is there to study high-performing organizations than Formula One racing? And all that knowledge I built up came in incredibly handy, okay? So pay attention to things where you say, look, that's interesting, even if you do not even know how it's useful. And finally, discomfort. You do not understand what we discuss, or you disagree with it, and that's absolutely great. If you immediately understand everything I say, and if you agree with everything, this workshop was pretty much worthless for you, okay? So the very idea is that from time to time you have a little bit of discomfort. So these are the 4 categories: stealing, inspiration, oyster, discomfort, okay? You need to take notes. I'm excited. I see some of you already have like a pen in your hand and you're kind of already actively taking notes. And I want to very strongly encourage you to do this. There's very clear research on this which shows that taking notes has a positive effect on your learning. If you just sit in and lean back for like 3 hours, it's still going to be nice, it's still going to be interesting, but you're going to be a little bit like a podcast. It sounds good as you listen to it, but you don't actually learn a ton about it. Okay? That also brings me to kind of go into one of the questions some of you have already asked in the chat room. Will there be a recording and will you get the slides? And the answer to both of these questions is a beautiful no. There will not be a recording and you will not get the slides. And let me briefly explain you why, okay? So I taught this workshop 2 years ago to like 100 executives, and these 100 executives had paid a ton of money for it. And they said like, look, Henning, we need to get the slides, we need to get the recording. And I was like, okay, you've paid a lot of money, I'm gonna give you the slides. But before I gave them the slides, I played a small trick on them. As the very first slide in the slide deck, I put in a slide where I said on big letters, if you open up the slide deck, within 1 year, me teaching you this workshop, I will transfer you $100, no question asked. Now you should think, oh shit, Henning is crazy. He has 100 participants, $100 each. That's going to cost him $10,000. No, it ended up costing me $200. Two of those people, who all 100 insisted on getting the slides, actually opened the deck. Okay, so the thing about it is, you will basically, after this presentation is over, you will go back to your mobile phone, you will go back to your colleagues, you will attend to your family. The last thing you're going to do is to say like, let me watch like a 3-hour recording again. Not going to happen. Instead, if I tell you, I give you the slides, you will not pay attention, and will, because you have the illusion, you can always come back to it. So I will fully leverage what all of you have, FOMO, your fear of missing out, okay? So you have now 3 hours, and you can get as much out of it as you want, okay? But afterwards, when you don't get it in 3 hours, it's gone, all right? When you take notes, you can write a note that what is something you steal, what is something that inspires you, what is an oyster, what causes you discomfort. Obviously, I do not expect you to be like a sponge that sucks up everything, right? There's going to be a lot of material, but there are going to be different kinds of nuggets for each of you. And these main kind of takeaways will differ across the year. I sometimes get asked, what is the one major takeaway of your webinar? And if you're like, what kind of a shitty webinar would that be, where you have one major takeaway out of 3 hours, okay? So there will be different takeaways for different kind of people, all right? So you should treat this a little bit like you would read like a scientific paper. You highlight the stuff you then want to come back to at some point, okay? You can always ask questions, okay? This is, I believe, the 50th time today that I do this workshop. So my brain functions pretty good at this point in talking about stuff and reading the chat in parallel. So I will read your questions in parallel. If you have a question, don't hesitate to put it in the chat. I might not always engage with it because I kind of want to kind of stay in the flow and make progress, but I will always have a look and kind of try to weave it in as good as I can. If you feel your question did not get answers, I'm going to do a Q&A session at the very end, so you can always bring in your question at the very end. Okay? So, you obviously need to pay attention. Look, mobile phones are basically killers of attention. Research is very clear on this. If you just pay attention to your mobile phone for about 10 seconds, it takes you about 25 minutes to get back up to your level of original concentration. So there is no way how you can say like, oh, I'm just going to take a brief look at this text message. There's a different way of thinking about this. Your attention is probably the most valuable resource you control, okay? And by just looking at your phone, you're basically outsourcing the control rights for that resource to some random person who just feels like sending you an email. And honestly, I do not know how you should allocate your attention, but just outsourcing the control rights to a random person is probably not the best way of going for it, okay? So, also, we will use the class a little bit to cultivate relationships among you, and if you engage in another kind of conversation in parallel, that's going to be very hard. By the way, when you ask me questions in the chat, please ask public questions, because it's a little bit odd to answer private questions publicly. Yeah. But you will get a bit of a profile, yeah. And I'm also going to give you an overview about who you are interacting with and so on. In terms of the format, this will be a little bit of an interactive monologue. So I will talk quite a bit, but I will also kind of draw on you, and we're going to have group work and so on. PowerPoint slides will weigh down on you. I will do my very, very best to stimulate you visually and intellectually. I know it's not easy to pay attention for 3 hours, and I will make my very best to kind of make it easy. In terms of the roadmap, there's going to be a bit of lecturing on venture capital business angels. We're going to have quite a bit of group work on kind of the problems in interacting with startups, financing startups, and we always have the chat where you can ask questions, and you can also answer each other's questions in the chat, okay? So it's not just me who can engage, but you can also kind of crowdsource like an answer to your specific question. The reason why I do this webinar so often, so I briefly mentioned this I believe like the 48th or even 50th time that I do it, is because I want to keep it as a reasonable size. And my experience has been the moment it goes above 300, it becomes a little bit difficult.
5, 4, 3, 2, 1.
should you actually evaluate startup venture? We will not talk about negotiation or collaboration. The reason for this is very simple. Normally when I teach this material, I have about 3 days to do so. Now we have 3 hours. So I give you a broad overview, but obviously I can't touch every topic or go into depth on each of these. Okay? Venture capital is a fun topic to talk about at INSEAD because Jean Choriot, who has been, according to this book, kind of claimed to be like the first venture capitalist, is also the founder of INSEAD. And let's kind of give a little bit background about this because it also gives us a feeling for what the venture capital industry is about. Choriot used to be a professor at Harvard Business School at the end of the Second World War. And what he realized is, oh wow, now that the Second World War is over, the economy will change in fundamental ways. New industries will emerge, and there will be much more people around because you need less soldiers and so on and so on. But what he realized, to build all these new industries, to build these new kind of companies, you need a new type of financing. Because it's not feasible that you can just walk to your bank and say like, hey, I'm creating a new company which will bomb with a chance of 80%, please give me a loan. A bank will typically not give you a loan. So what he realized, we need some form of risk financing where the investor takes a bigger risk but then also participates in the success of the company. And so venture capital was born. The way John Doerr puts it, who's an accomplished venture capitalist, he's currently the senior director at Kleiner Perkins, and he puts this very nicely. The best way to predict the future is to make it. The second best way is to finance it. And that already, you see, this notion towards the future already gives you a bit of a feeling for what this industry is about. It is a tiny industry if you compare to other parts of the financial industry. You can see this here. The assets of the 2 largest US hedge funds are currently $353 billion. The assets of the single largest US private equity firm are $512 billion. And the assets of all 1,328 active US VC firms have $444 billion. Okay? So the whole volume the industry is dealing with is less than the volume of a single private equity fund. Okay? It is an industry which works very much like at the edge of the future, so to speak. So you can see this here, right? It just invests a fraction of the GDP of the US, but 42% of all public companies are venture-backed. Venture-backed companies represent 63% of the total market capitalization, and venture-backed companies account for 35% of total employment and 85% of total research and development spend. So this already gives you a feeling, I'm not making any claim that this is causal in any way, but you can see how venture capital is really associated with like high growth companies, okay? It all goes a little bit back to this beautiful definition of entrepreneurship by Howard Stevenson. Entrepreneurship is the pursuit of opportunity without regard to the resources currently controlled. And you see, I always find this incredibly liberating because it really allows you to think about opportunities without thinking about whether you have the resources that you can actually implement them, right? So imagine like Elon Musk thinking about like building an electronic car company or kind of developing a rocket startup, right? He didn't have the resources at the time, but he was actually free to think about it without paying all that much attention to whether he had the resources. But this is then where venture capital comes in many ways. Because at some point, you require the resources, right? Your idea, here represented by this light bulb, needs then at some point the complementary resource to make this idea a reality. So, this brings us to the question, why can it be crucial for startups to raise money from venture capitalists or business angels? What is the benefit? Please type your answer into the chat. Yeah, speed, you can hire more, you can scale faster, you can like help on strategy, correct? Yeah. So you're covering a lot of good points, you're missing like 1 or 2 which are actually important. So let me give you like a little bit of a systematic overview here, and then also add the ones that you're missing out on, okay? So, an important aspect, by the way, about the slide is the can, okay? I'm not saying venture capital always does that, venture capital can do that, all right? So, obviously, if you start collaborating with venture capitalists, you get the money. That money allows you to hire, to scale, to accelerate your company, right? It's only enables growth. You can do stuff you couldn't do before. You also get advice and mentoring, right? You avoid mistakes, you're faster. Ideally, the venture capitalist you're working with has actually quite a bit of experience, and you benefit then from that. You can tap into that experience and benefit from it. There's also enormous governance potential, right? It might be that the very first time you set up a company, right, for the founder might have no idea how to set up a company. But at that moment, the venture capitalist comes in and says, like, look, I can tell you how to structure a cap table and stuff like this. How do you pay employees? How do we kind of structure these kind of things? So you get guidance in these kind of questions. Then, enormously important, it really boosts the status or the reputation or the trust or credibility, however you want to call this, of your venture. If you start out as a startup, you're very often very small, right? You might not have a lot of credibility in the marketplace. But if you can then say, like, look, I am financed by this prestigious venture capitalist, or I am financed by this kind of prestigious business angel, it gives you a lot of credibility. And that can then again help you to find better partners, to hire better people and stuff like that, right? Think about the referrals, right? So these are very often venture capitalists or business angels often have a huge Rolodex with tons of people they know. And so that allows them to partner, it allows them to hire, and so on, right? So it's not just the general status, but they might also make very specific introductions. And then there's a phenomenon which people often don't pay attention to, but turns out to be quite important, and that's what's called a social defense, all right? And the social defense is the following. Imagine you're like a small venture, and you're collaborating with a large collaboration. Now that large collaboration might not actually treat you in a fair manner. For example, they might not pay your invoices, or they might delay the paying of your invoices. They might also infringe on your patents. And obviously, if you're just a tiny little startup and this large corporations kind of goes after you, that becomes very challenging. And now a venture capitalist can be extremely helpful in two ways. The first thing is, it actually can bring you resources to fight back, right? You can lawyer up, right? Suddenly you can now go back and say, like, look, we are going to fight for our rights here. But the second aspect is almost more important. The venture capitalist can go to the large corporation and say, like, look, you're not treating our venture particularly fairly, and look, we will now tell all the other ventures we are working with and all the other venture capitalists we are working with that you are not a trustworthy partner. And so suddenly the large corporation has enormous reputational risk. And that is something the corporation will be concerned about, because it will still want to be able to work with startups in the future. All right? So you leverage the connections, you leverage the connection of the venture capitalists to foster better behavior by other actors in your network. Okay? So Rita points this out, power asymmetry very much, and by kind of getting a venture capitalist on board, you kind of fight against that. Now, you might say, look, this is all nice, but I still don't need venture capital to succeed. I can just do this. Somebody writes the screen is not visible. If somebody else has problems, please write in the chat. Otherwise, I assume it's fine and it's a local issue for Sandeep. So you might now say, like, look, this is all fine. I understand these advantages, but I can still do this on my own. I don't need venture capital. Okay? But here's the thing you want to take into account. Maybe you can make it without venture capital, but also consider what happens if you try to make it without venture capital, but your competitors raise venture capital. Okay? So what can happen is that your competitors raise money or more money than you, and then they use that money to outcompete you in the operational business. So let me give you a recent example of this. The ride-sharing service Uber just raised way more money than the ride-sharing service Lyft. And what Uber then did is that they used all this money they had raised to fight very hard against Lyft, okay? So they hired away their drivers, they hired away their software engineers, they set like such low prices to compete for customers that it was almost impossible for Lyft to compete against that. And so while Lyft said like, look, we want to really build like a sustainable business here with the money we have, Uber just said like, look, we are having way more money and we are using that money to kind of squeeze you out of the marketplace. Okay? So you might think you can do it without it, but be aware what can happen if other people raise venture capital. Of course, there are tons of reasons why you should be skeptical of raising venture capital, right? So, alternative forms of financing might be advantageous. For example, you might be able to get government funding. You might be able to get funding from family and friends. You might actually get funding from your customers who immediately kind of pay you. So there are alternative ways of financing, and these might be beneficial. Then there's also the issue of dilution, right? It's not as if you get $1 million for free, no. If somebody invests in your company, they also want to have part of the shares. So you actually benefit less eventually if your company becomes a success, right? And you also have a loss of power. You might suddenly have like strategic disagreement. You might say, well, I want to build a European startup, and then they say that the venture capitalist is like, no, this has to be global from the beginning on, and so on and so on, right? So. And also, very important, it takes effort to raise venture capital, right? It's not as if you're supposed to like snip, now I get venture capital. You actually need to spend time on it. It's quite a bit of effort to raise. Okay? Now that we've talked about, look how great this can be, it's a little bit of a maze to actually raise venture capital. It's not completely trivial to get there. And so the idea of today's workshop is to give you a short overview over this maze. It's still going to be a maze, it's still going to be complicated, okay? But you can navigate it a little bit better afterwards. Luckily, there's tons of research on VCs, and also people are very active talking about their practice and so on. Okay? Vijay Duff points out another skeptical point is the idea grab. It can happen that venture capitalists kind of take your idea away. Look, this can happen, this has happened. I believe it's a little bit, people are more concerned about it than it's actually a problem, because venture capitalists are also typically busy and the people they interact with are also busy. So it's not that easy to steal an idea. If all you have going for yourself is really just an idea, it was probably not the greatest idea in the first place. Okay? So, let's start out with prime and venture capital, and we look where the money flows. So, we focus here on the venture capitalist and the founder. I will often use this as an example of the venture capital firm Andreessen Horowitz, A16Z. The reason for this is very simple. It's a relatively young venture capital firm. It got created in the mid-2000s. And then very quickly become one of the dominant venture capitalists. And so it's like a nice example to see how this kind of can play out, how you can establish yourself in that business. At the focus of all this is the venture capitalist, and the venture capitalist is also called the general partner. Okay? There's a hierarchy within the venture capitalist. At the very top is the general partner, then below there's also like a principal, and then the associates. We will talk in this class only about general partners and principals, okay? And then there's the entrepreneur, and as you've seen from the animation, right, the money flows from the venture capitalist to the entrepreneur. We've already talked about this. The VC brings money, advice, status. The entrepreneur, a proven idea, and the willingness and ability to work very, very hard. But let's kind of extend, I mentioned this, right? So GPs and principals have different decision rights. At the very top is the GP, the general partner, and then on the second line of command would be the principal. So let's have a look here. So the money originally comes from limited partners, and then the vast majority of the money, about 98%, is then invested in startups, but 2% is directly paid as fee to the venture capitalist or the general partner, as salary to kind of rent an office, and so on and so on. Do you have an idea who are limited partners? What kind of actors are limited partners? Please type your answer in the chat. Sovereign wealth funds, high net worth individuals, corporations, insurance companies, pension funds, yeah. Yeah, so it's a very wide range. Yeah. Let me ask you the question a tiny little bit differently, okay? Could I, Henning Piezunka, could I be a limited partner and invest in a venture capitalist? So could I become a limited partner? So everybody who writes, yes, you're so naive, what an assistant professor INSEAD earns. That would be beautiful. No, I can't. There's a minimum amount of investment you need to bring, okay? And that lies typically for, in particular for the established venture capitalist, you need to bring a few millions. So I suggest we actually stop here. You all give a donation to INSEAD now, earmark it and say like, this is for a salary increase for Henning Piezunka, so that it can actually become a limited partner. No, I do not have the right kind of money to do this, all right? So you would typically need a few million to invest. Let's think about this, right? Think about the people you've kind of said are typically limited partners, right? If you raise money from like pension funds and sovereign wealth funds and so on, why kind of dealing with small-time investors like me, right? There's no point in doing it. There are obviously this difference. There's some venture capitalists where this could kind of start like a few $100,000. There's so-called rolling funds where you can actually invest just a few $10,000. But in general, if you want to actually invest in one of the established venture capitalists, it's there's very often a very high minimum, often sometimes up to a few million US dollars. Okay? So then the money actually flies towards the entrepreneur, and at some point money rains down from the sky, and then there's some form of a liquidity event. Okay? Do you have an idea what a liquidity event could be? What is a liquidity? How comes money come back into the circle? IPO is the most common and initial public offering. Yeah, very often also mergers and acquisitions. So, and then the money is basically split up. But before we look at how the money is split up, let's have another look in kind of the different kind of events. So I'm very much in love with this chart here. What you can see here from 1918 to 2019, the percentage of total exits, okay? And you can see it's separated into IPOs, so initial public offerings, and mergers and acquisitions. And what you can see is in the 1980s, they're basically just IPOs, okay? There is really absolutely nothing going on in terms of mergers and acquisitions. But nowadays, in 2019, okay, it's basically almost only mergers and acquisitions. And so one of the key things that has really changed is you have a lot of corporations like Google, Apple, Facebook, Microsoft, Cisco was very early on, who are very, very hungry in acquiring young startups. They see this as a fantastic way to manage competitive threats, the so-called killer acquisitions, and also to hire high potential employees. Okay? This might now more recently change through like new financial instruments, through the so-called SPACs and so on, but this is kind of has been the general trend over the last 40 years. Okay? In terms of how long it took you, right? The number of years, it used to be around 8 years. Nowadays, it's more like 11 years. If you just look at the companies which go for IPO, okay? And the reason for that is that there's simply much more money available in the private market nowadays. It used to be, if you wanted to raise a few $100 million, you needed to go for an IPO and go towards the public market. Nowadays, you could also just kind of go to like a private equity house or a large venture capitalist and say like, look, we would like to raise like $2 or $3 billion as venture capital, and you would very often, if you're performing, you can get that kind of money. You can also see this here, just looking at these kind of examples, right? So Amazon was created in 1994 and then went for IPO in 1997, so after 3 years. For Google, it already took 6 years to go for IPOs. Facebook, it took 8 years, and Uber, it took 10 years. And you can see also how the valuation of these companies actually increases continuously. Okay? Harris, could you please mute yourself? Because you not mute, but you are, thank you. So, this this chart has actually two interesting implications beyond the evidence that it takes you longer to guide for IPO. One thing, so I can't make a comment simply because I do not know, but I often get asked like, oh, are we currently in a bubble? And you see, people are always complaining that valuation for ventures are too high. That has always been a complaint. For some of you who are old enough, they might remember when Google or Amazon actually went for IPO. And when Amazon went for IPO, I just saw the clip the other day. People were laughing about it and saying, like, how can a company that doesn't make any profit be evaluated with $661 million? Well, that price has now increased by a factor of 2,000 since then. Okay? So it's very difficult to kind of say, like, look, are we in a bubble or not? The second aspect about it is, what you can see is that an enormous amount of growth of these companies is at this point actually realized why these companies are still private, not when they are public, right? So if you invested, I haven't looked at this recently, but I believe if you invested in Uber at the time of the IPO, you actually made a loss, okay? So everybody after 2014, I believe, actually made a loss. So more and more of the growth of these companies takes place while they are private, okay? And so that makes it harder for like the small share owner to actually participate in the growth of these companies, okay? The money is then split up, okay? Part of the money goes to the founder, part of the money becomes the VC's cumulative net income. What's the VC cumulative net income? The venture capitalist keeps about 20 to 25% in what is called carried interest, and then the rest of the money goes back to the limited partner, okay? And that very much kind of concludes what might be called the virtuous cycle of venture capital, because ideally that money is then again reinvested, okay? Let me briefly catch up the question. Leander, M&As typically happen for older companies. Look, in the chart I showed, these were purely venture-based backed companies, and these used to be young companies. So this would not be like Daimler merging with Chrysler or something like this, okay? Artem, I'm not sure I get your question. Maybe you can elaborate on it a little bit. Okay? And by the way, thanks to everyone who kind of answers each other's questions. That's fantastic, okay? Supriya asked, what's the basic difference between private equity and venture capital? I'll come to this in a minute, okay? So let's have a look about VC as an asset class. If you actually think about like capital markets, these are the kind of pictures which come to mind, right? People on stock exchanges kind of exchanging stocks and information. So the question is, how is investing in ventures as a VC different from investing in stocks, all right? So there are a few core differences. The first is the returns on investments are much, much more skewed, all right? It would be quite common that a venture I invest in goes bankrupt, all right? By contrast, very few public companies quickly go bankrupt, okay? I can also not reverse my trade easily. If I buy Amazon stocks in the morning and in the afternoon I think like, oh shit, this was a bad idea, I can just sell it. I can reverse my trade. By contrast, if I invested in like 3 startup founders, I cannot just turn around and say like, this was a stupid idea, now I'm going to sell it. No, you see, there might not be a market for it. I might not be allowed to do it according to the contract I signed, so it's much harder to.
Not so loud, guys. I'm listening here.
And also,
I got the class.
Post-investing competitors. Obviously, there's quite a few venture capitalists to do, and the reason for it is I'm also expected to foster the venture. So I cannot just say like, look, let me invest in this venture and then I'm going to do anything. The idea is also that I am supposed to help that venture, all right? And then there's publicity of information. Look, for public stocks, the very idea is that the information is public. If you can now call me up and say like, hey Henning, I know something about BMW nobody else knows, do you want to trade? I would be like, are you engaging in insider trading, right? By contrast, if you would say, I know 3 founders who are building a great venture, but nobody yet knows about it, I would be like, hey, cool, can I invest? Okay? The information is also unevenly distributed. Some people might know a ton about the venture, other people not. And then, and we'll come back to this, access is very difficult. Think about it. If I wanted to buy Amazon stock now, who do I need to ask? Please type your answer in the chat. if I want to buy Amazon stock, who do I need to ask? So you're right, I don't need to ask anyone, right? I could just basically, I could call my bank and say like, buy Amazon stock, and I'll buy it. By contrast, if I wanted to invest now in a young startup, I need to talk with all the founders, I need to talk with current shareholders, and I need to have them to do it, okay? It's also a venture class which has a lot of variance in it, okay? So here, what you can see here is actually a comparison of different kind of venture investment classes. And you can see on the left-hand side the dispersion from the media, okay? Give me a second here. It's the dispersion from the median. And you can see this, right? So this is basically, look, you take the average of all the investments in an asset class and then look at how big is the standard deviation. If you invest on the very right in taxable bond mutual funds, these are doing more or less all the same, all right? So if you told me I've just spent like 3 weeks to pick the right taxable bond mutual fund, I would be, you're an idiot, okay? These are all performing more or less the same, just pick anyone. By contrast, if you said like, I invest in venture capital now, I'm a limited partner, and I just picked like a random one, I would be like, are you crazy? Because there's an enormous difference between the best performing venture capitalist and the lowest performing venture capitalist. So it matters enormously in which one you invest. Okay? In terms of the general kind of risk assets, you can see this here, right? The annual, you see venture capital in the upper right corner. The annual return is very high. The standard deviation is also very high. Okay? So it's a high risk class, right? Obviously, the last 2 years it has gone very well. But you know how they always say, right? Returns in the past are not a guarantee for returns in the future.
Okay.
Some of you had already asked what is the difference between venture capital and private equity. This kind of image kind of expresses it a little bit, all right? For private equity, you need to have a lot of financial muscle. What you're doing is you basically buy established companies, okay? The private equity company would say like, look, we are going to buy this supermarket chain because we believe we can run it more effectively. But you're buying large companies with a lot of assets. Venture capitalists, oh look, there are like 3 people in a garage and they think about they can create an app and $100,000 would actually help them a lot. That would be more venture capital, okay? So venture capital business is very much you invest into the growth of companies where the future is still uncertain. Private equity is you buy established companies where you believe you can run them a little bit more effective, okay?
Pwede man to sa unang dili na kinahanglan.
Let's think a little bit about industry dynamics, okay?
Ato bitong gikuan sa murag
venture
consultant ba.
capitalists has changed and alternatives to venture capitalists have emerged. I want you to pay attention to 3 different components of this chart, right? So let's first start at the very left, okay? The cost of starting a technology company, right? So the cost of starting a technology company goes down and down and down and down and down, okay? You can see this. Look, when I created like my kind of company in 1998 with my best friend, right? So we actually had to think about buying a server and stuff like this, and it was all incredibly expensive, okay? Nowadays, if you want to create like a tech company, you basically go on Amazon AWS, and shoots you go, and you have everything set up, okay? And you can basically just rent
ato lang meetingan siguro dyan with Rolin.
At the same time,
Sa maayo ani sa Lunes siguro. Or ugma schedule ko ugma kay Lunes na ako'y kuan hindi ko pwede ugma na lang dyan i-relate lang ni mag-set of meeting niya
so we now see like these 2 contracting movements,
ugma na lang
the cost of
saka oras bakante ugma
but
dyan
funding has actually increased, and this is not to say it has never been easier to start a company, but it has never been harder to make it
pakatanaw ko sa Rolin ha o gulay ko
think about it. What has basically happened is the entry barriers have gone down tremendously. And so a lot of people can enter and try something, but so it becomes harder to make it a success. Now let's have a look at the front part of this picture, all right? In the 1960s, 1970s, 1980s, you have these venture capitalists which are really like providing risk capital. That's what we talked about in the beginning when we talked about Joshua Wheel. In the 1990s, competition in this industry starts emerging. And what they try to do is they try to build brands and to differentiate. So companies like Sequoia Capital emerge, and they become very effective in competing for deals, like competing for opportunities to invest in startups, but also in competing for limited partners so that they give them their money. In the 2000s, you then see an emerging focus that these venture capitalists really try to focus on different areas. When you think in terms of focus in the realm of venture capital, you can think along two dimensions typically, okay? The one is, let's focus here on the horizontal first, whether you focus on a particular stage, all right? So do you say like, I just do like early stage funding where you do like seed financing, stage A or so? Or do you invest in multi-stage where you say like, I invest very early, but also very late in like stage E, stage F, so different forms of growth financing, okay? And you can see in the chart, there are some venture capitalists which are focused purely on a single stage, either early stage or late stage, but then there are also multi-stage investors which go into all stages. And then, of course, you can specialize in terms of sectors. You might say, well, I only do robotics, I only do biotech, or you might say, no, I'm going to go across the whole spectrum, okay? So, then you also see the emergence of more international VCs emerging, right? Like companies like Index Ventures. At some point in the 1990s, 50% of the worldwide venture capital was invested within 20 miles of Palo Alto, all right? And you see, like, that's obviously a great place. I've lived there for 6 years, but let's don't kind of fool ourselves. It's not as if 50% of the worldwide great entrepreneurs would all live in Palo Alto. And so venture capitalists realized it just makes a ton of sense for us to kind of go more international. You then have what's called super angels and micro VCs. Instead of building like a large venture capital firm, these would be individuals who say like, look, I'm rich or I have rich friends and I'm going to kind of basically invest their money in young startups. Then around the 2010s or late 2000s, you also have more and more accelerators emerging. You see here, for example, 500 Startups, Techstars, Y Combinator, okay? And these are basically companies who say like, we are going to take in a cohort of young ventures and grow them at the same time and kind of try to help them to become larger companies. By the way, the current president of Y Combinator is an Inside alumni, Geoff Waltz, and I just did an interview with him. If you're interested, I'm happy to send you the interview. Just kind of type yes in the chat, and I make sure that I'll get you the video of the interview later on. Okay? Oh, this is nice. Okay, very happy to see that there's interest. Okay, excellent. Oh, I'll get you the stuff. Okay? And then, like recently, you've also seen like more platforms like Kickstarter, AngelList, and so on. And you see this chart ends here in 2010s, but there obviously continues to be innovation in that realm, right? Like the initial coin offerings and so on. Different ways of how we can get money from investors to young startups. Okay? So, let me briefly talk about INSEAD and venture capitalists. I don't want to do too much navel gazing here, but a few of you have asked, so I'll briefly talk about it. In generally, MBAs have been very good at raising funds, all right? So if you look at this chart, you can see INSEAD is at place number 6, and it has raised about around $11 billion, okay? The students have raised $11 billion. You can see in the very last column some of the companies which have raised this, like BlaBlaCar, TransferWise, and so on. The reason why I'm so happy with this chart is because you see, you might say like INSEAD is placed number 6, but here's the thing. On 2 dimensions on which we really compete, I would say we're actually doing extraordinarily well. So of the schools in the top 10, INSEAD is actually the only standalone business school, okay? And that obviously makes it quite a bit harder. And so we're doing very well in that respect. The other aspect about it is, in the top 10, INSEAD is the only school outside of the United States, all right? And given that venture capital is more kind of established in the United States, that kind of shows that we're actually kind of punching quite above our weight here, okay? So in that sense, I'm actually very happy with how INSEAD is performing here. Right. If you look at the kind of ventures if you look at the kind of ventures that students have created, it's really all over the place, pretty much kind of capturing the diversity of the INSEAD student body. Okay. Here's an example. On the left-hand side, you see Tavid Hinkikus, and Tavid used to be a student at INSEAD in 2010, and he got really annoyed by the transfer fees. So he transferred money from his home country to France when he was based in Fontainebleau. And he was like, look, this is like a joke that every time I transfer money, I need to pay like 1 or 2%. All they are doing is a stupid transfer. And being the entrepreneur he is, what he did is he created then a international money transfer business, TransferWise, okay? And that company is now evaluated, last time I checked, with more than $5 billion. If you're interested, it's a really interesting story. I'm currently finalizing a case on TransferWise. It's recently got renamed into Wise. If you're interested in the case, I'm happy to send you the case once it's done. Again, just type yes into the chat room and I'll get it to you later on. Okay, it's so pleasing to actually see that there's interest in the stuff on those. INSEAD MBAs have also gone directly to the VC, so they've not kind of tried to raise money, but they've actually tried to invest it themselves, and this has worked well. So here, for example, a former student of mine on the right-hand side, Spencer. I taught him in 2015, and Spencer was like, hey, I'm going to become a venture capitalist, and I was like, yeah, good for you, and took it like half serious. But off he went directly after the MBA. He raised 60 million British pounds, teamed up with a high net worth individual, and has recently raised a second fund of like $100 million. So it's doing extremely well. Okay, and you see, like I mentioned, Jeff Walston, who's currently the president of Y Combinator. So, few takeaways here. INSEAD alumni have successfully operated as investors with venture capital or startups with venture capital, and also you don't have to be in Silicon Valley to get venture capital. Okay, that industry has become truly good. A short disclaimer: venture capital works differently in different countries. Okay, it matters whether you are in the UK, whether you're in Asia, whether you're in Europe, whether you're in the United States. You can see one of these differences here, right? So this tweet by Dan Forbes, for example, although Europe has many large firms, they don't buy startups at the rate US firms like Cisco do. This makes it riskier for VCs to invest in European startups as VCs need exit paths. So you can see this here nicely, right? On the one hand, venture capital shapes the economy, but of course also the economy shapes venture capital, all right? If you don't have a lot of exits, it becomes very kind of difficult for venture capitalists to engage. Right? While there are these context-specific differences, most of the issues we discussed actually apply across contexts. Okay? What we will do is we will take both perspectives. We take the perspective of a VC and the perspective of an entrepreneur. And as we take both of these perspectives, what we get over time is a well-rounded image of the industry. Okay? I forgot to create this before, but let me quickly do this. I'm interested in which kind of perspective you're more interested in. Let me quickly run a poll. No, don't type it in the chat, that will be messy. There we go. Please briefly complete the poll. Five more seconds. 5. Zero. Okay. So you can see this here, right? It's actually quite nicely spread out. The biggest category is what makes me very happy is both. Most of you are actually interested in both categories. Then we have 30% more focus on startups, 30% on investors. There's an interesting research finding on this. In general, whenever you are engaged in any form of collaboration, it really pays off to understand both perspectives. Okay? So you really want to understand both sides. For those of you who are dating or even in particular if you're married,
pass ako.
you have
Okay.
experienced how much it actually can
Murag
pay off
workshop
to
ni,
understand the other
time to
side
time,
perspective.
tubag.
Okay?
Love you.
There's also, you can see this here, this research which has been conducted by Will Maddox and INSEAD, why it pays to get inside the head of your opponent, even when you compete, right? It really pays off to understand the perspective of the other side, okay? So, let's talk about access, okay? Here's the thing, there are many entrepreneurs, but just very few good ones. And there are many VCs, but just very few good ones. And so what we will now see play out is basically like a matching market where all the entrepreneurs want to have the good VCs and all the VCs want to have the good entrepreneurs. Okay? And so the question is, who actually gets what? How is this actually going to work out? I've said there's not a major takeaway, but if you kind of put a gun in my head and say like, Henning, tell us one major takeaway, I would be like, this is the major takeaway, okay? You generally need a partner, and this is something most people actually get wrong. You need a partner that is interested and interesting. Let me put this for you in dating terms. You need a partner that is attractive and attracted, okay? If there's a partner that is attractive to you, but not attracted to you, it's a recipe for major heartbreak. If there's somebody who is attracted to you, but who's not attractive to you, it becomes a major annoyance, and you need to find a way to deal with that person. It's not different for venture capitalists and entrepreneurs. A venture capitalist wants to have entrepreneurs which are attractive, but also are attracted. They want to have the investment from the venture capitalist. And the entrepreneur wants to have venture capitalists which are attractive, so can really help them to move forward, but are also then attracted, right, that they're actually willing to invest. Look, this is actually a little bit like a dating market, okay? So you first attract the partner, then you select the partner, you write a prenup, and then you're happily married ever after. Now you might say, well, Henning, look, if there's an investor, and even if the relationship goes well, there's an exit between the investor and the entrepreneur, I would say that's true, but the length of the relationship between an investor and an entrepreneur for a successful exit is longer than the average marriage in the United States lasts at this point, okay? So this example carries me a pretty long way. We start now out here with the venture capital perspective. So the question is, how do you get access from the VC perspective? Another way of framing this question would be, can the VC attract deals? How can the VC generate deal flow? What can you do that you have access, the opportunity to invest in ventures? Okay? So, access means whether you have the opportunity to invest in ventures. And here's the key thing, access. Not screening or evaluating, not negotiating, not collaborating, explains most of the variation in the success of venture capitalists or business angels. Okay? It's really access. If you have the opportunity to invest in high potential entrepreneurs, you will do well, right? If the founders of Instagram or YouTube come to you and you can invest, you have the opportunity to invest, it doesn't matter whether you're shitty at evaluating or negotiating or collaborating, you will do well, okay? By contrast, if you only have low potential entrepreneurs coming to you, it doesn't matter whether you're good at evaluating or negotiating or collaborating, okay? You will do poorly. But here's the funny thing. Most people who want to learn about venture capital want to learn, this being a business angel, want to learn about evaluation and negotiation. Okay? That is what people's key interest is. But that is not how you make a difference. Okay? Let me give you an example, and that will appeal particularly to the heterosexual man in the audience. Okay? Imagine I wanted to date a woman. Okay? And I've now the issue is typically not that I'm bad in evaluating women or that I'm bad in negotiating a prenup, okay? The issue is that women don't want to date me. I'm speaking from experience here, okay? So I should not actually buy a book and say like, hey, how do I get better in evaluating women? No. Instead, I should actually go to the gym and invest in my physical capital. Or I should go to the library and invest in my intellectual capital. Or I should try to be more funny, okay? But, so I want to focus on access. How do I get more opportunities to them, okay? The same is true for venture capitalists and business angels. It comes down to the question, do I have the opportunity to invest in kind of good ventures, okay? It's basic, but I can't stop thinking about this. VC is an asset class where the best assets pick their investors. So please, so the reason for this is just to explain the second sentence here, right? The good ventures have choice. Okay? If you're a high potential founder, there are many venture capitalists who compete for having you as an investor. Okay? So the conclusion from that is spend less time trying to be a good picker and more time trying to be worth being picked. Okay? So to use the analogy from before, I need to go to the gym, I need to go to the library. Okay? A good venture capitalist attracts ventures like a magnet. Okay? So let me talk a little bit about what you can actually do in that role. And I will differentiate these actions that a venture capitalist can do into two broad categories. Okay? The first one is fishing and the first one is hunting. Okay? So think about what you do when you fish. You more or less sit around, you have a great bait, but you wait for fish coming to you. Okay? When you hunt, you actually run after the prey. The two are not mutually exclusive for the actions, but I want you to kind of think about these alternatives. So, fishing. How do you actually attract ventures to come to you? First things first, you attract attention via success. Nothing attracts like success. VCs that were successful early on tend to remain successful. Okay? Ventures want to go to venture capitalists which had success in the past. The dynamic is very easy. Outstanding success early on affects the VC's ability to attract ventures in the long term. Okay? There's nice research on this, for example, most recently by Ramana Nanda, Samsa Samila, and Olaf Sorensen, which show that if a venture capitalist is successful early on, it has super long-term ramifications for their performance because they continue to be able to attract better ventures. Okay? But now, if you're not yet a successful business angel or not yet a successful venture capitalist, the question is obviously, what can you do? Okay? So, first, have an attractive background, as also it sounds. You remember that I used it as an example Andreessen Horowitz before, right? Here you see one of the two co-founders, Mark Andreessen, when he's 20 years old on the cover of Time magazine. Okay? So he was like a rock star software engineer before he became a venture capitalist. So if you think about like, look, you want to become a business angel 2 or 3 years from now, the question you should ask yourself is, what can I now do in my career with my life that would then render me like an investor that people want to have, okay? You might also want to engage massively in public relations activities. So Mark Andreessen tweets on a very regular basis. They have a podcast. They have best-selling books. You can see how this pays off, right? The New York Times reports about them. Andreessen Horowitz, the deal maker to the stars of Silicon Valley. You don't have to do this on the same scale, but you want to be known, right? You want to kind of get the word out that you are like a potential investor. One aspect that I always find incredibly important to mention in this context, please, 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 do not worry about attention in general. You need to have attention from the right kind of people, okay? So this is not about you going on Facebook and asking some stupid question where then like 100 people then engage on, okay? You need to have the attention from people who are actually creating startups, okay? So don't worry about general attention. You just need to have the attention from the right kind of people. Okay? You might also organize events, right? The best way to get invited to the party is to host the party, right? So, for example, I never get invited to any parties, but then I started hosting my own parties, and that's actually like a good way to actually come to you and create a network. It breaks my heart that nobody thinks it's a joke when I say like I don't get invited to any parties. Seems to be very realistic. So anyway, so hosting like my own brunches or parties has been like a nice way actually for me to build up a network. Okay? You want to have a strong expertise and make sure that people know about it. So take this example again, I stick with Andreessen and Horowitz. They wanted to invest in more artificial intelligence startups, and what they did is they set up a website which they called the AI Playbook. And that sent a very, very strong signal, okay, to everybody saying like, look, we are really experts and interested in artificial intelligence. Okay? You also want to have a message which is very clear and appealing to founders. And again, something where Andreessen and Horowitz came up with something good, right? So, one thing that happens in the industry is that very often venture capitalists replace the CEO, okay? Don't get me wrong, that's not necessarily a bad thing. There's actually research showing that this is a good thing on average, okay? Just because somebody took a company from 0 to 1 does not mean that the person is qualified to take the company from 1 to 100. It might be in your best interest to replace the CEO. But here's the thing, surprise, surprise, founder CEOs don't want to be replaced in their own companies, right? It's not as if Steve Jobs was thrilled when he got fired from Apple, okay? People who have founded companies don't want to get fired. And so Andreessen and Horowitz realized this, and they very actively communicated that they prefer working with founder CEOs. They like working with founder CEOs, okay? So they really kind of say, instead of firing you, we will work with you, kind of educate you, build a strong team around you. So, now we come to the second part, hunting. How do VCs hunt? You headhunt from your personal network, very important, okay? You might have to reach out to people you already know on your personal network. You interact with companies that have failed, okay? You interact with universities, right? Very often, great ideas come out of universities, right? Think about it, where will the next new kind of laser come from? Where will the next new vaccine come from? Very often there might be like an assistant professor, a postdoc or so, who has a great idea, but doesn't yet know how to commercialize it. Or you might act as judges in idea competitions. Whenever I teach my class at INSEAD, the students need to present their ideas, and then I have like 2 or 3 venture capitalists coming to class, and they kind of evaluate these. And it has happened that people then ended up kind of forming an investment relationship. Okay? One aspect that I also find interesting, and this, a lot of you might actually know this from hiring. Very often the entrepreneurs you really want to invest in may not actually look for investors, right? So you might actually want to find people who are not looking. So the question is, and please don't write it in the chat, I'm going to open up a poll, okay? How big do you think is the overlap between entrepreneurs with great potential, okay, and people who actually want to become entrepreneurs? And please don't type, because I will actually give you a choice in a minute, okay? So, let's have a look here at the different options. Is there no overlap? So there are people who are likely to become an entrepreneur, and the people with the potential to be a great entrepreneur, there's like no overlap. Is there a little bit of overlap between the two? Is there quite a bit of overlap? Or is there an enormous overlap? Okay? So the question is, are we living in a world which looks like A, B, or C? And please complete the chat, the poll. All right, 5 more seconds. All right. So, you can see most of you kind of believe we're either living in a world like B or C. I'm always fascinated people who believe like A, there's like no overlap, so every founder is basically not a person who kind of has potential to be founder. But so, look, my key question is not whether we live in like B or C, it's more about the implications of that. So let's assume we are living in a world like C, okay? So there are two implications of this if we're living in a world like B, okay? So the first about it is, look, there is a big blue part which does not overlap with the red part, right? So most of the people who are likely to be an entrepreneur don't have the potential to be a great entrepreneur. And the consequence of that is, as a venture capitalist, because these people will seek your funding, you need to say no to most of the people who try to get funding, okay? The most common thing you do is that you reject people. To give you a feeling of the dimensions, a few years ago, I know this Andreessen Horowitz got 4,000 applications and they invested in 20, okay? So, of 200, they invest in 1, okay? This is also why a lot of venture capitalists actually become really good in rejecting people. If you're interested, by the way, in rejections, I have devoted 5 years of my life to study rejections. So I'm a real expert on it from personal experience, but also research-wise. So if you want to know something about rejections, just type yes into the chat, and I'll make sure I get you the article on rejections I've written. That article did not get rejected, it actually won a prize. So I feel rejections are right now evil. So. Alright, so you need to kind of, okay, super, very happy that there's interest, okay? But then there's also the red part, right? And you can see there's an enormous red part which does not overlap with the blue part. So there are many people with the potential to be a great entrepreneur, okay? But they're unlikely to become an entrepreneur. They might have very comfortable corporate jobs or something like this, right? And so you might actually go to them and convince people to become an entrepreneur, okay? Because they might be unwilling to become. So these are two like important takeaways here. Be good in discipline and say no, and also be willing to kind of convince people who have talent to be an entrepreneur but might be unwilling to become one. All right? So we have now concluded the venture capital perspective. What we will do now is that we take the ventures perspective. Okay? So how does access look from the entrepreneur's perspective? We have so far talked about how do venture capitalists gain access to entrepreneurs. Now we're talking about the other way around. Okay? So, raising money is an activity entrepreneurs need to be good at. Whoever decided that the word fundraising should start with the word fun had a sixth sense of humor, alright? This is actually hard work, alright? Some students actually recently pointed out to me that the word funeral also starts with fun. And the word fungus also starts with fun. So you start wondering if there's some kind of pattern that thinks that the word fun are explicitly not fun, okay? You see, this is a little bit of an operation you really need to plan. So how does the operation kind of fundraising look like? First thing you need to get right is the timing of all of this, all right? Founders generally underestimate how much time fundraising takes. I recently interacted with an entrepreneur who had like a heartbreaking story. He had created a startup which was really working well, okay? So he had paying clients, it was a very cool kind of product where you could see like, look, this makes the world a better place. But he was not yet profitable. And he realized, oh, I have money, if we continue the way we do right now, the company will run out of money in 6 months from now. But he also realized, in about 24 months from now, by the very latest, they will be profitable. So what does he do? He tries to raise venture capital. He has 6 months left, all good, right? So, what does he do? 3 of those 6 months, he invests in finding an investor, you remember, who is attractive and also attracted. Okay? So he has an investor who he wants to have an investor and who's in principle willing to be an investor. But 3 of the 6 months are now gone. What happens next? The investor does a due diligence, and that due diligence takes, it's a bit of a complicated business, takes 10 weeks. And at the very end of the due diligence, the investor comes to the conclusion, we will not invest. So now he has money left in the bank for 2 weeks and immediately files for bankruptcy. Because at that moment, he has no time whatsoever to raise more funds. Okay? So, conclusion is, raise money long before you need it. Okay? Otherwise, you find yourself in the same situation as the CEO and founder of FedEx. Alright? You can see this here. In the early days of FedEx, the CEO, Fred Smith, needed money to keep the company alive. He owed $24,000. After a business loan was denied, he bet the company's last $5,000 on the blackjack table in Las Vegas and won $27,000, which covered the fuel bill and saved the company. Okay? This is not a way to finance your company. I also want to say very explicitly that gambling with company money is illegal. So please don't get any ideas from this class. Okay? That's like the last thing I want to happen. We learned in an INSEAD lecture that we could actually gamble with our money. This is not with company money, not allowed. Okay? Find other ways to finance your company. The first thing is you want to organize your fundraise. Okay? You want to have very clear internal responsibilities. Ingram Maurer and Mark Ebers have a very nice example of this. They looked at biotech companies. And what they found looking at biotech companies, the biotech companies that were most successful in raising funding, actually they said, like, look, we are going to create like a small team within the company which is only responsible for fundraising. And the rest of the team continues to run the business operationally because the two don't really mix well. They have different kind of time scales, there's a different language, and so on and so on. Okay? So have somebody with very clear responsibilities. You also attract via signals, right? I find this tweet heartbreaking, but it's so true. Most investors want to invest in companies that would succeed without them. Most employees want to work on products and teams that would succeed without them. The best way to get help is to get yourself to a place where you don't need help. If you have ever tried to get a bank loan, you know this to be true. If you really urgently need the money, the bank is typically unwilling to give you a loan because you're at bad risk. Okay? By contrast, if you have plenty of money and you don't really need the loan, the bank is very keen on giving you a loan. Okay? So the best way to get yourself help is to get yourself to a place where you don't need help. Okay? Send the right signals, okay? You already need to have accomplishments under your belt, both to get on the radar of a venture capitalist and to survive the screening process, okay? So, be a winner, for lack of a better term. What does this mean? Have traction in your operational business, okay? Find ways of standing out, for example, by winning prizes. This can obviously be other things, right? You might successfully file for a patent or something like this, okay? This is also crucial for the timing of raising funds, okay? You want to try to raise funds after you just had a success, after you acquired an important customer, after you won some prize, after you got a patent granted, okay? Think about it. When do you try to get a salary increase, right? You don't try to get a salary increase after you've just kind of blown off the roof of a factory or something like this, right? I go to my dean and ask for a salary increase after I've won a teaching award or after I've won some prize, not after I've just gotten a paper rejected, okay? So fundraising is no different. You want to have some kind of success and then you actually ask for it. Okay? You also attract via connections. Look, VCs tend to work with ventures where they already know the founder or an employee. Okay? Why do you think they do that? Why do VCs often invest in ventures where they already know the founder or an employee? Why is that?
It feels like, but there's nothing there.
So, you hit the nail on the head. The most important word you're pushing here is trust. Okay? You tend to invest in people who you trust. And you know what? I think that's perfectly fine. I don't have an issue with that. All right. If you put down like $100,000 as a business angel or $1 million as a venture capitalist, you want to invest in somebody you trust. Okay, that's fine. But please stay with me for a moment. Let's kind of take a bird's eye perspective. Let's zoom a little bit out from the specific situation between the founder and the venture capitalist. All right. Here's the thing. The vast majority of venture capitalists are white Caucasian men. Okay? And now, guess who white Caucasian men are typically friends with? Yes, white Caucasian men. And so, if white Caucasian men then only invest in people who they already know and trust, it results in a systematic discrimination of people of different genders or ethnicities, right? Without any kind of malicious discrimination going on, okay? So, but it continues to replicate the same kind of very odd equilibrium we are in, where certain people just have a very hard time getting access to funding, okay? So that is something I will say that on top of that, there's also explicit discrimination. For example, research shows that women get asked more difficult questions when they ask for funding. The same, by the way, is true in research seminars. Women very often get asked more difficult questions on their scientific papers. So there's also a systematic discrimination going on top of that. Okay? So if you're working in these spaces, you want to be aware of these kind of biases to be able to de-bias yourself. Okay? A colleague of mine is a very nice. So you might ask, why do we actually bring up like topics like gender or ethnicity or discrimination in entrepreneurship class? And a colleague of mine has a very nice saying about this, where he says, like, look, if we don't teach our students about inclusion, we are putting them at a disadvantage for the workplace of the future. And I couldn't agree more with that. Okay, I couldn't agree more with that. You need to be ahead of these kind of things. To say like you don't care about inclusion at this point in time is a little bit like saying you don't care about software. It will play an important role in your life, whether you like it or not. Okay. By the way, if you're interested in topics like inclusion, this is probably the article I wrote, which had the biggest impact in my life. I wrote something about the role of like business schools in fostering gender equality. If you're interested, please write like a yes in the chat room, and I'm like, sure, I'll get you the article. Okay, it's about what's the role of business schools in fostering gender balance. But I believe it's actually applicable a little bit more broadly beyond that context. Okay. You can see, like, this is just one example how drastic this can be. What is the percentage of funding that goes to people who have a Latino or Black or Latino background? And you can see this, it's only 2.4% of the funding, right? And obviously in the US, these ethnicities take a much larger portion of the population than they are actually represented in venture funding, okay? So, we'll talk about screening. And one thing that I would now like to do as we kind of come into the topic of evaluating ventures, is that I would like to form groups, because I want you to collaborate as groups in terms of how you actually kind of evaluate these ventures. We are going to run through like 3 short group exercises, okay? And this all peaks in like how you evaluate a venture, all right? As we do that, one thing which would be important is that you stay on for all 3 exercises, because otherwise it becomes quite annoying for your other group members, because you will have different roles in your groups. So if you say like, great, I have time, I enjoy this, I want to stay on for at least 45 more minutes, then please stay on. If you say, I hate group work and I had enough of this shit, please sign off now, okay? What you should not do is to stay on for 5 more minutes and then sign off, okay? So please either sign off now, okay? Or stay on for at least 45 minutes. The break comes later, but not now. right, I give you 10 more seconds. So what we're going to start with is we start with a little bit of an icebreaker. The icebreaker might feel actually annoying, but I have done this now, as I said, 48 times, and I've done it quite often without an icebreaker and sometimes with an icebreaker. And I can tell you the performance of groups which actually have kind of exchanged their first name is so much better than if you don't do this. There's also very strong research on this, okay? So take like 4 or 5 minutes so that you actually kind of learn a bit about one another. I'm going to put you in groups with like 3 to 5 people, okay? And so you have a chance actually kind of briefly kind of exchange your names and stuff like that. So, and again, wait a second. So, as I kind of send you in this group, you should do the following thing, all right? Write down your breakout room number, introduce yourself to your 2 teammates, and please, please, please take a few notes on your teammates, okay? The better you know your teammates, the better you will perform in the eventual exercise, okay? And I'm going to give you like 4 minutes to actually meet one another, write down one another's forename, and actually learn a bit about one another, okay? So I might reshuffle some of you if I realize, look, a group got too small or something like this. But this is otherwise from where we are going to start. Let me end up bottom. So, and here we go. Have fun.
Hello, hello.
Hi there.
And
How are you doing? Let's take a quick one. I can start. My name is Robert. I'm living in Denmark. I do business performance work for a global company at the moment, but I'm very interested in startups and specifically around raising capital for startups. So that's why I'm joining this webinar. That's all for me. Who else?
okay, hello, Robert, and I'll go next time. Hi everyone, I'm Evie. I'm from Taiwan, but my mom is Indo, and used to be ex-consultant, but in the end, ended up in the startup world. Now working in the fund, like in the program and also the fund. So I kind of like hunting for the good startup to invest for now, and also looking for a full-time job in the fund.
Nice to meet you.
Hi, this is also Renee. Sorry for not having a webcam. I basically don't have that at my room right now. So I'm working with a bank in Germany, Frankfurt, and the topic that I'm rather focused on during my work is basically around business development, so kind of digital innovation, collaboration with like the fintech environment, hunting for like kind of the new ideas and things like that. But also I'm interested in getting kind of a private angle towards the topic to really leverage my professional network and kind of move towards taking a more active role as kind of an angel investor in interesting companies, potentially over the next 2 to 5 years. And yeah, happy to join, happy to meet everyone, and really interesting to see how that group work turns out.
So Irene is the last one, I think. Are you there?
Calling for the other lady, calling for the other lady. Yeah, don't say she's
So 10 seconds left. So see you later, guys.
Countdown 3, 2, 1. Nothing happened.
Hey, Tia. Hey, Smira. Hey, Wanshay. We're going to give people...
So, Henning, we didn't have a whole lot of time in there, and we barely got,
It was too short.
we barely got introduced, to be honest with you. So
Very short.
because it was slow. I mean, basically people came in and they weren't revealed, so we were waiting for a long time. And anyway,
Got
we
it.
didn't accomplish what we needed
In
to.
our team, it was only me who introduced yourself, frankly. So
Alrighty, so I will give you another, so don't worry about it, because you're going to have 3 exercises, and I'm just going to add a little bit more time to the next exercise, so you can catch up on that, okay? So don't worry about it, you will actually, look,
Sounds good.
Rin said you need to do complete MBA within a year, right? So you need to learn to introduce yourself within 4 minutes with technical difficulties, all right? So, but point well taken. So now let's actually get some real work done here, okay? So next breakout session, what you need to do is you actually need to kind of grow the startup, okay? So imagine you're an investor, okay? One of the ventures you're advising is led by a team of 3 very close friends who have known each other for many years and share a close bond with one another, okay? A close relationship. The collaboration between them has worked very well. However, as their venture has been growing, they've struggled to further extend the top management team. The people they've tried to onboard, although highly qualified and possessing the skills they needed, somehow did not click well with the team. How would you advise them and or intervene from the outside to overcome this important growth challenge? Okay? So what I want you to do is please discuss it as your part. As the group session ends, one member of your group should write your solution into the group chat. The first thing is you determine who is that person going to be, who's the note taker, okay? When that note taker then enters the note, please enter your group number, first names of the people in your advice. Please do not hit enter in between so that we have it as one response. If you want to have more lines, just hit shift and enter, okay? That kind of gives you a new line break, all right? What I'm going to do is I'm going to give you a bit more time now than I would normally do, so that you actually have the chance to reintroduce yourself. You're going to have 12 minutes, but after 12 minutes, I expect like a great answer to this question, which would kind of, at least at like high consulting quality, okay? So you have 12 minutes, high performing team. I might actually reshuffle 1 or 2 teams. So don't be surprised if you're suddenly part of another breakout room, if I feel like the group has gotten too small because 1 or 2 people signed off, okay? So don't be confused if you're part. I give you 12 minutes so you can reintroduce yourself and work on the thing. Because you will not be able to see my slide once I send you the breakout room, I have now entered it into the chat because you will be able to continue to see the chat room. So if you want to read it again, you can just look at it in the chat room. Okay? Super, all right? I'll open the rooms and send you in. Have fun.
Okay, any thoughts? Any thought?
Do we have Irene now?
How would you advise
Not
them?
yet.
So they are friends, but they don't work well with each other.
I guess since everyone has the incentive to really grow the company, I think it might be a good idea to remember them why they initially started a company to really build something interesting, Now I think it's really like for them to ask for their kind of determination to the company, whether they feel comfortable in really taking it to the next level, and really if they are like hungry to go into the next level, they should take they should be open to get whatever help they can receive to really achieve that goal, even if it's like not pleasant to them because they are getting challenged from an outsider. If they really want to achieve the goal of scaling the company, I think that's like really kind of the core here, to really get their inner motivation right. And if they say, for us it's kind of more the friendship that's in focus here, which is also okay. I think it's just like kind of a judgment call that they have to take now, and really be transparent in kind of what two routes there might be: ending up in a scaling company with an outsider, or potentially having kind of a dysfunctional company that is dying slowly by being only with their previous teammates, I guess. So at least that would be kind of my proposal, and really, kind of getting their view of where they want to be, let's say in 1 or 2 years, and really, and be kind of thought-provoking in that aspect, and make them kind of engage with their inner selves and their ambitions and everything.
Yeah, I kind of have. I agree on you. It is like you need to think for the bigger, like for the greater good, right? And I used to run a startup, and I just realized that when the company is so small, it's inevitable that you are so close with each other. Like, it's just so hard when you like doesn't work well, but there's no room for you to kind of escape. It's like, okay, it's not in my department, I just don't talk to the person. No, because the team is just that small, so you have to work with each other, right? So what I did before is that actually I commonly onboard a person and then let the person work with the team. So after the probation, it's like, I need to check with everyone in the team, right? Are you comfortable with working with a person? Because you need to work so long hour with the person for so like tightly. So if there's anything you don't feel comfortable, then, just like it doesn't work. So to me, that I think, because three founders are kind of the key pillar of the startup, and they are kind of like, okay, we need to be here, right? So any outsider join need to be comfortable for everyone. If not, then I'm sure there are more talent you can get in than just like try to get anyone to work with another person. Though it's kind of like there's an ideal way, because that sometimes as a startup you don't get a lot of application, right? So you probably need to decide it just from one candidate or two, and then that will become another story. It's like, okay, then how urgent do we need to fill in this position, and then can that be something on the contractor base? So we try with a person for 3 months if we really need it, and if we really hate it, then then we at the same time we find another person to fill in. Yeah.
And I guess there is also, as you correctly said, chemistry is like really something that is key when it comes to a startup, I guess. But I think given that they are like kind of now on the edge on becoming a kind of a more advanced startup, I think it's also important for them to understand what will be like the next 3 to 4 growth areas or topics that they have to address in order to scale their business and match their existing capabilities and also kind of time resources to that. Because if there is, for instance, one guy who's like working 24 hours, I think that cannot run as good as in the past, given that just like too much pressure is on him. So he ends up in making failures and things like that. So I think it's really important to understand what's like kind of the next key issues that need to be addressed, and how can we match it with our resources, and where is room to get like externals that can help here, and where also the other existing startup guys have the time to to kind of align him with the corporate and the culture there.
Yeah, I think there's important to know that what kind of role that person play, right? So if the person is just like, okay, I just more in the tech, like for example, there's a tech guy, there's a sales guy, and there's a designer, right? So just like when we need to onboard more tech guy, then if the tech guy feel okay, then I think it's okay because the tech guy will be the one that works the closest with the person, and the rest, even though they don't really work well, but there's still a buffer there. And if there's the end goal, as you said, to grow the company, to have a stronger tech solution, then we need to kind of respect whatever the tech had said. Any comments from Robert and Jeffrey?
No, I'm nothing from me here.
Yeah, I agree. Just like it's, but somehow that you need to solve the problem, right? Just like you can't just like, okay, yeah, we don't there's the chemistry is not there, then how can we actually solve it? Just like, nah, hire another person. What if there's the only person they can get? Then what is the next? Like how the game should go along from that.
I guess with regards to the time, I think we'll now have to kind of decide on what would be like kind of our advice and what would be like kind of our suggestion on how to overcome that. So potentially we can agree on like 3 to 4 items that we can kind of provide as an answer. What do you guys think?
Practical way, I will say that I will check how urgent is it, and if there's a not and like the resource wise, right? There's like, okay, so can we get a second like alternative candidate to work with? And if there is a yes, then okay, we try to find another way. If not, then I would say if this position is urgent, then we hire them, but for 3 months. So to like get everyone a trial session is like how difficult is it while we find another person to fill in at the same time, so we can keep the ball rolling. It's kind of, yeah, because you can't really force the chemistry, right? Or try to build a voodoo doll that get the person to like each other. Yeah, because I think that for people, right, just like if you tell them that we hired the person for good, then they kind of like they will be way more conservative than just like no, I really don't like the person. It's like okay. How about we hire the person for 3 months as a contractor or even for as a freelancer, right? So it's like your miserable life will worse will end in 3 months. Then like okay, for the greater good, can we move on? Probably yes. So that's kind of the only way I can figure out.
I guess what would be also kind of interesting to better understand what it means. Somehow it did not click well. So whether there is like something where they, I think the time is running out. Whether it's something just like on a personal basis or professional as well. So.
So is this the moment that we're typing in our responses?
Yes. What you can also do in case you haven't yet done it, but I'm going to repeat this in a minute.
We didn't have time to do it before, so.
Yeah. No. You can now actually type in your response. And if you aren't sure in how the names of your teammates are written, I've actually put all of these up on the screen. So you should all kind of take a note in how these are written.
Henning, just to understand, sir, we need to type in the conclusions, or we need to reference the people with the idea?
that would be nice, actually. Yeah. By the way, everybody, even if you're not the note taker, you should actually kind of write down now the first names of your teammates and your room number, and because you will need this again for the next assignment.
Okay. So here we need to put against the names their ideas. Is that what?
Yeah, exactly.
Yeah, exactly. Okay.
I believe that the bottom of the table is not visible.
Well, that would not be good.
Henning, I did type something in my team, but it doesn't appear here. Will you have it?
Maybe try it again. Otherwise, in general, let's go back to using the chats again, because if everybody kind of speaks up, it becomes a little bit of a chaos with 200 people, okay? So if you have a problem, type it in the chat. Of course, up here, I realize if the chat is not working, that's a little bit hard, but. All right, so thanks, Team 40. Looking forward here to Team 28, 31, excellent. So you also get a little bit of a free exercise here in speed rating by taking part in the seminar.
Yeah, so, sorry again, it's actually, where do I need to type the
into the chat room.
In the chat room, okay, perfect.
Yeah. So where there's two, you just say everybody, and then you can type, and then you can type away.
Okay, thanks.
All right, if you haven't yet typed it in, please kind of type it now. And also, if you haven't yet, please, if you're not sure about it, but your group number and the first names of your other team members, please write them down now. They're on the slide. Alrighty, so what I would suggest to you is you can see in the chat, you have these 3 points at the right bottom. You can actually save the chat room. So what you basically just got here is a fantastic kind of crowdsourced way of integrating people. I had a chance to read through quite a few of those. Some are very good. There's one aspect that some of you actually got, I would say, like, which is not like in line with the cutting edge of research. And let me kind of briefly outline this, because I think it's a mistake people often make when they are facing this situation, okay? The situation here I described, by the way, is very often faced by startups, but it's also faced by other kind of companies, right? Think, for example, of family businesses, right? Family businesses would very often face a situation that you have a very strong set of bonds among some people, but then it becomes very difficult to integrate like non-family members and integrate non-family members into it, okay? So the mistake people typically do, and a lot of you have avoided it, but a few have actually suggested it, it's a very intuitive way of thinking about it, is that you say like, oh, look, we have 3 friends, now we integrate a 4th person, let's make sure we also become friends with that 4th person. And so you wonder about, what can I do to basically bring that relationship onto the same level? And you think about organizing like offsites, or you go for like regular dinners and stuff like that. And what research shows is that that typically does not work, okay? So research on social networks is very clear on this. The 3 people have what is called a unique shared experience. And it's very difficult for people then to opt into this, right? So imagine the following: I become friends with you, and then I also hang out with you when you hang out with your high school friends, right? No matter how much time I spend with you personally, I will never be able to kind of really chime into the conversation you have with your high school friends, because I did not go to the same parties, I didn't have the same teacher and stuff like this. So what you should do instead of kind of trying to build this pseudo friendship on the run, is you should actually try to separate this new person a little bit and define the relationship professionally. So you should basically say like, look, here is what we need exactly from you. Here are the specific goals. Here are the specific resources you get. And this is what we need from you, but this is also what we will offer you. And what sometimes works fantastically well is also to physically separate that person. So instead of saying like the 4 of you now sit in the same office, you actually say like, look, we set that 4th person in a different office, because otherwise that person starts being seen a little bit like an intruder who's basically kind of affecting the space in which you're operating. So in a funny way, you improve the relationship by separating them off a little bit. Okay, so, but otherwise, there were other kind of great ideas in the chat room. So take the time, download it, and kind of read through it more carefully. All right, now, next exercise. What I want you to do is now to act as a VC investment committee, okay? And what you need to do is you need to actually decide in which ventures you invest. Keep in mind, there are different decision rights between general partners and principals, where general partners have a larger kind of effect on the decisions. They have more voting rights, basically, okay? What I will ask you to do is now that you and your team, you need to decide in whether to invest in a set of ventures. You need to vote very simply, yes or no. I will show you 9 ventures, and all you need to do is yes or no, okay? The listed venture is a real venture, but it is disguised. Please, please, please don't use your precious time trying to guess what venture it is. I had 8 PhD students looking at these 9 ventures, and 1 person got 1 right after 4 hours, okay? So don't worry about trying to figure this out, you won't. Imagine you would evaluate this venture in 2013. By now, I do this because these are all companies which tried to raise money in 2013. I do this because I want to evaluate you and whether you're actually picking up the right venture. And I can give you a little bit of feedback on how good you are then in picking the right venture. By now, in 2021, it is evident whether it became a success or not, okay? You're graded on whether or not your team, that's very important, not you yourself, but your team makes the right decision, okay? But as you evaluate these ventures, you need to think of yourself, how would I think about this venture in 2013? You should actually enjoy going mentally to the year 2013, okay? There was no Trump presidency. There's no coronavirus, no wildfires in Australia. A lot of great things in 2013, okay? You can make as many or as few investments as you want, okay? Vote on ventures that will help your group to perform. So, and now this is a little bit tricky, okay? It's a team task, but you do it individually on your own. How does the two go together? What will happen is I will ask each of you to vote on your venture, and then I will aggregate your votes towards a team decision, okay? So also it's a team task, but you do not communicate it. So I will give you a survey, and each of you fills out that survey independently. You will be graded as a team, all right? And then afterwards, you kind of get a chance to meet and to debrief the results. In terms of the survey, if you have a question, use the chat and send me a private message. Please don't say it out loud. Please don't say it to everyone, because I want to make sure everybody can kind of work focused on this. And you need to fill in the complete survey, okay? I'm going to send you the survey now via the chat.
I have a question. So is it simple majority that decides the team's decision on an investment?
So a few things about this, Gerard. First, please use the chat. Second, It is an excellent question, okay? I will give a detailed answer to this question in the survey, okay? In how the voting works and how many votes you have and stuff like this, okay? And yeah, so there's, so all this information will be in the survey. I will now send you the link towards the survey in the chat box. And you should all see this now. And here we go. You have 30 minutes time. I will tell you what I always laughed and hated when I did all these kind of standardized tests. Take your time, but pace yourself, okay? You're gonna lack time at the end, so you wanna pace yourself. Not to rush, but push a little bit.
We have 30 minutes, 3-0.
Yes, 3-0.
Thanks.
And please use the chat. In case you have forgotten your team number or the spelling of your first names of your teammates, I have just put up the corresponding slide again so you can read it up on the slide. I think I'll ask you in like filling out if there's one slot too little if there's one slot missing because you have like 6 team members and there are only like 4 slots for teammates, then just fill in the first 4 and I'm going to complete the rest.
Hello, Henning. I don't know how to put room number 25.
Say this again?
How do I go to room 25?
No, you don't go to the room. You just open the survey. You just open the survey link that I put into the chat and fill out the survey. There's no breakout room. And no more outspoken questions, please. Just use the chat. I put the link towards the survey again into the chat room. If there's the same question twice, which should not be the case, then just fill it out twice. And keep in mind, you do this on your own, so you do not communicate with your teammates. Only private questions in the chat room, please. And you have still 20 minutes left. You have 13 minutes left. You have 9 more minutes. 8.5. 3 more minutes. There are a few questions after you've decided on all the ventures, so time to wrap up. Alrighty, time is up. Why don't we do like a 5-minute bio break? If you still kind of want to finish the survey, you can use that to finish the survey. Otherwise, you can go to the bathroom, grab a coffee. Yeah. Some of you have asked whether you can connect with me on LinkedIn. You're very welcome to connect with me on LinkedIn. You can just search for me and kind of reach out and follow me or connect with me. There's only one Henning Piezunka on LinkedIn, so it's not hard to find. And otherwise, we see each other in 5 minutes from now and then do a strong finish. Okay, so thank you so much, and we see each other in 5 minutes. Alrighty. If you're back, it would be great if you could switch on your image. Samir still looks like debating the exercise with his partner. Very nice. Yeah, so if you're back, please switch on your video. That makes it a bit easier for me to know who's around. And right, Cattell, I like the shoulder exercise. So, all right. Special respect to Yoti, who is kind of taking care of her child in parallel. It looks sweet from the outside, but it's incredibly hard when you actually need to do it. So, alrighty, maybe you can use the chat and share a little bit like what were your main difficulties in the exercise when you're evaluating these ventures? What were things you really struggled with? Time, okay. Going back to 2013, okay, we were all younger then. Okay, you didn't have the financial numbers, yeah. Lev pointed out before he didn't have the terms, and that bothered him as an experienced investor. Okay, sometimes an unclear exit strategy. Yeah, I can see that. So I put some of you into the position of a general partner where I basically give you like 2 votes. So for those of you who had 2 votes, how did they make you feel about it? Like, how did you feel about having 2 votes and as a result having like a larger influence? More present, more cautious, more responsibility, okay? You thought twice, okay? I hope so you thought twice, you know. All right, so what I will do is within the next few weeks, I will send you your results. So I will tell you how you did, okay? I will also, because look, I'd run this exercise a few times and people ask me like, who is doing how well, who is doing how much to invest? And then I actually started doing a little bit of kind of regression analysis on it. So I will also kind of beyond your personal results, I will also give you a little bit of an overview over kind of what drives of decision behavior, what drives performance. In case you were worried about it, I will not share your material with the INSEAD marketing department, okay? So it's not like, oh, look, you have a sibling, that's another person we can sell an MBA to or something like this, okay? So I'm using this for like my regression analysis and I'll give you some feedback on that, but otherwise I'll delete the data, okay? So you don't have to worry about any further usage or so. But of course, we welcome all of your siblings to do an MBA at INSEAD, no question about it, okay? So let me get back to my, let me get quickly back to my slides that we can then push on, okay? So as we think about, wait, can you, no, you can't see my slides, sorry for that. I put myself in the presentation mode, but not yet you on. Here we go. Super. So as you evaluate ventures, it's basically very much about 2 types of errors, okay? It's about so-called type 1 and type 2 errors. And let me quickly kind of summarize what that is, okay? So on the left-hand side, you see what's called a type 1 error, okay? Great.
We are seeing the slide, the whole slide, and not the presentation slide.
Oh, that's not good. Thanks for letting me know. Let me stop the share.
You need to be in the presentation mode.
Yeah. You see, not only do I not get enough salary to kind of buy become an LP, I don't even get enough kind of money to buy like a great computer. So no, it's not true. It's just me complaining. Being a good German living in France. Okay, can you see it now?
It's a black screen.
Yeah, it's black.
No, the blank screen.
It's like
that's
it's like radio. We hear you, we don't see you.
Maybe you just need to choose the window from PowerPoint where you are in presenter mode.
Okay, let me give this another try. Share screen. Here we go. Can you see
the
that?
light sorter again? Oh, no, now it's working, yeah.
Okay, excellent, super. So type 1, type 2 errors, okay? So on the left-hand side, you see type 1 error. Great news, you're pregnant, okay? And that man is obviously not pregnant, right? And on the right-hand side, you see it says here, you're not pregnant, and that woman is obviously pregnant, okay? So what does this mean in the context of a venture? A type 1 error in the context of a venture, also called a false positive, means you invest in a venture that does not become a success. And the result is you wasted some money on the venture. Type 2 is a false negative, okay? The rejected venture becomes a success and you miss out on a huge payday. So you said no where you should not have said no, okay? And look, venture investing can be pretty much summarized as this. Paul Graham, the founder of Y Combinator, puts it this way. Investors are pinched between two kinds of fear, the fear of investing in startups that fizzle and the fear of missing out on startups that take off. And so that is really what you want to avoid. So let's have a look at like a representative portfolio of venture capitalists, okay? So imagine you're investing in 10 ventures, okay? So you're putting down like some amount, like 100,000 or million into 10 ventures. Now, because these are all like high risk ventures, most of these will actually go bankrupt, okay? So boom, 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 okay? So 8 out of 10 cases would typically fail. If you look at like your typical venture portfolio, that would not be uncommon. Then one venture will do okay and give you a return. But as you can see immediately from this chart, that is not going to do you much good, all right? But now, and I ask you to pay attention to the very left-hand side, but also to the very right-hand side, one venture will now do extraordinarily well, okay? That's at least the hope, that one venture in your portfolio does enormously well. These are the so-called 10x or 100x ventures, which return 10 or 100 times how much you had put in, okay? This distribution of losses to profits on a product level, you can also know from other areas of the economy, right? So for example, publishers who invest in books, right, would up typically, on the typical book, they actually make a loss, but then there are like 1 or 2 which become big hits and are then actually crazy profitable, okay? It is, by the way, exactly the reverse of the insurance business. In the insurance business, you actually win a little bit of money on most of your clients, but then you lose a lot of money on those clients which actually have a damage, right? So imagine you sell fire insurance and most of your customers, you actually earn some money, but those where the house burns down, you actually lose a ton of money, okay? So here it's the reverse. You make a lot of investments in ventures, but then 1 or 2 of them which become a loss, but 1 or 2 of these should actually become big hits. So the way one of the business angels I always invite to class puts it, he always says, I don't minimize risk, I maximize upside, okay? And that is really what you're concerned about if you're a business angel or a venture capitalist. You're not so concerned about whether the venture can go bankrupt. That can always happen. What you're concerned about is whether that venture can indeed become like a major, major success, okay? That is what this is about. Here you see an example, Benchmark, which is a venture capital firm. They own 11% of Uber, which is worth around 10 billion US dollars. just on that one exit, they will return 26 times of their 2011 425 million fund, okay? That's the idea. You have one investment which is so strong that it returns the complete fund. In terms of philosophy of selecting ventures, we've already kind of talked about one aspect here. You invest in ventures that often fail, but then you often but then you end up having a winning portfolio by making like one or two investments which go spectacularly well off, okay? So the other thing is you're very often a contrarian. So if you want to be very successful as an investor, you need to be accurate in your assessment of the assets, of the value of assets, but you also need to be different. If you just believe what everyone else believes, you're unlikely actually to make a profit because then the price of the asset is already reflected in the price. So you want to kind of go where other people don't go. And this has led to what Peter Thiel's called so nicely the contrarian question. Write down something you believe to be true that most people believe to be false. And I would actually like you to do that. But before you do this, let me kind of add like two or three more things about this. As you write something down, please write down something from the sphere of like business or technology or science or innovation. So please don't write, I believe Elvis Presley is still alive, okay? That might be contrarian because you believe it to be true and most people believe it to be false, but I don't want to hear that kind of crap, okay? The second aspect about it is, please try to put a number on it. So don't say, at some point humans will be on Mars. Try to write something like by 2040, 1,000 people will live on Mars. That way we can kind of verify it, okay? Or when you say like electric vehicles will have like an 80% market share in the year 2030. So that we can clearly say true or false at some point, okay? One of my favorite answers I got so far was that somebody said like by 2035, cricket will be one of the 3 revenue strongest sports in continental Europe. It was contrarian because nobody believed in it, including in the session, but it was very clear and specified. And the person was actually very smart about it. He said like, look, the fact that nobody believes that cricket will be a major sport is not a flaw of my idea, but it's an asset because I can now actually buy like cricket teams relatively cheaply and so on, okay? So on that note, write down something you believe to be true that most people believe to be false. I will admit this is probably my favorite part of the class. I don't have to do much, and I learn about all the kind of interesting thoughts you have. What I will now do is that I actually launch a poll with some of the suggestions you made, and now you can actually decide on whether you believe these to be true or false. Yeah, so have a look and please fill out the survey. Alrighty, I give you like 30 more seconds. Alrighty, so let's have a look at what you came up with here. All right, so most of you actually succeeded in the following sense. You wrote something you believe to be true that most people believe to be false. Okay, so Pascal, I believe blockchains won't scale and will be irrelevant by 2030. The majority seems to think differently. Okay, Jakob wrote by 2050, 50% of the world's population will not work at all. 40% believe that to be true, but it's contrary, and the majority believe it to be wrong. Veronique believes the planet will be carbon neutral by 2025, so 4 years from now, and only 9% believe that to be true. All right. We have with us today, I believe, the leader of the INSEAD Hoffman Center, which kind of cares a lot about sustainability, and I would love to kind of talk with her later on what she thinks about this, but I guess there's still going to be plenty of work for us after 2025. 2034, Chinese will be the new English. 33% believes this to be true. And you can now see a little bit how this principle goes, right? The interesting aspect about it, what I would like to emphasize, the more likely you have this assignment right, in the sense that you said something contrarian, the more likely you are also to be wrong, right? Because you're basically going against the wisdom of the crowds. So if you go to question 8, right? Daniel suggests psychedelics and microdosing will be used in therapies commonly in the US. So Daniel, I have to tell you, unfortunately, you miserably failed the assignment, right? Because you were supposed to write something you believe to be true that most people believe to be false. It turns out you're with an 82% majority, okay? That makes it harder for you to make a contrarian investment where you can benefit enormously because other people are likely to jump on this bandwagon very quickly on. At the same time, you're also much more likely to be correct, right, than, for example, Veronique, who believes the planet will be carbon neutral 4 years from now, Okay, so you see a little bit this tension, right? And great investors manage to be both. They manage to be accurate and different at the same time. There are obviously famous examples for these kind of contrarian thoughts, right? Galileo Galilei is probably the most famous one, and yet it moves. But if we look actually at ventures, right, you see a few years ago, it was truly contrarian to suggest that you could grow meat artificially. And now this actually starts being more common, and they're actually companies which are making a good business out of it. Okay? So in general, as you kind of invest early on, it's very difficult to assess this, right? You see, like, as long as you invest like in established companies, right, you can see this here, costs and revenues easy. I took a bunch of accounting classes, actually getting bored here. But now look at the same young gentleman, the moment he needs to assess a new venture, shit, these ventures are different from public corporations. The only thing we have for sure, fixed cost, and so on and so on and so on, right? So it's difficult to assess the value of a company early on. Let me run with you through like one selection tool or one evaluation tool that you can kind of take with you, all right? The classics like discounted cash flow or multiples are not particularly useful because very often you just have no revenues in that stage, right? There's nothing you can discount, there's nothing you can multiply. So what I would like you to look at is the 7-domain framework, which has been developed by my colleague of John Mullins, who did a nice job of actually pulling together a few different frameworks which have been developed, okay? So we are looking at these 7 different domains, and you might wonder, what are the 7? I just see 5, but we'll come to this in a second. So the first one I would like you to pay attention to is the micro market domain at the bottom left, all right? And that's very simple. What is the value proposition? Is there evidence that customers will use and pay for our product? What is the cash flow of these companies? What is, and this is my favorite category because it's so important, it gets often forgotten, what is the customer acquisition cost? How much do you actually need to invest in a customer? Then there's the upper left category, market domain macro, market feasibility. What trends affect the broader market? All right, look at us. Right now, we are all using the software Zoom. That's a product 90% of us had probably not heard of a year ago or had never used, and now many of us actually live in that software, right? So that is something you really want to take into account. In which direction is the market moving? Then industry domains. If you have taken a strategy class which was any good in the last 40 years, you have heard about Michael Porter's 5 forces. How many customers are there? How many suppliers? What are the entry barriers? And so on and so on. Okay, that is something you want to pay attention to. I will say the following. People who evaluate ventures often overemphasize the 5 forces. The 5 forces is very good to figure out profitability in terms of power. But most ventures don't fail because of like a strategic equilibrium, but because they are not creating value. So pay more attention to the bottom left rather than to the upper right, okay? And then finally, what kind of resources does the venture have? Do you have a sustainable advantage that is difficult to copy? These are the so-called valuable, rare, inimitable, and non-substitutable, the so-called VRIN resources. Let me give you an example. Let's imagine we would be the founders of eBay, right? And part of what eBay built was an access to buyers and to sellers of used goods. So having that access to buyers and sellers of used goods was obviously valuable. They could make a transaction work. It was also rare. There were hardly any companies that had that kind of access. It was also inimitable. It's very difficult to imitate this, in particular once eBay is around. And then it's really non-substitutable. If you want to build something like eBay, you need that, okay? So eBay created these kind of RIN resources, and you really want to ask yourself as you evaluate a venture, will there be these kind of RIN resources? Team domain, you will pay attention to the goals. What is the commitment, the mission, aspiration, obsession, propensity of risk? And you will do so for 2 dimensions in particular, okay? The first is you ask yourself, because you want to invest in ventures that go big. Remember the portfolio, you don't minimize risk, you maximize upside. So you want to see, does this venture have the power to bring in like 100 times what I initially invest? So are they like super ambitious, super highly committed? The second thing is you also want to see whether the teammates are aligned. So I recently had a case where there were two co-founders, and one of them, please listen very closely, it sounds similar, but it's not similar at all. One of them wanted to create a premium burger restaurant, and the other wanted to create a premium burger restaurant chain. And as you realize, it's a completely different business whether you want to manage a chain or a single restaurant. And what happened, they had constant conflicts with one another, and the whole thing fell apart. Okay, the company went bankrupt after like 1 or 2 years because they had all these disagreements all the time. Also, do you have the skills? I know plenty of people who want to create an artificial intelligence startup who don't know anything about artificial intelligence. Okay, here's the thing: you actually need to have the skills, the technical skills, and so on to build this up, right? Or you need to at least be able to argue that you can recruit somebody who can. And then the team, the network, are you connected up and down the value chain? Can you access customers? Can you access suppliers who help you to build your product and who would buy your product? Okay. So obviously, this is not the kind of framework where you now say like, 5 times yes, 2 times no, 1.8 million evaluation or something like this. But what it does for you is actually it allows you a more educated guess. So you come to a better conclusion on whether you believe that venture is likely to be a success. So these are the kind of dimensions you should pay attention to. And of course, then we can go into much, much, much more detail and so on. Okay. This was pretty much it. So we started out with a primer on venture capital, right? What is this industry about? Where does it come from? What is the evolution? We then spent a lot of time talking about access, okay? How do venture capitalists gain access to ventures? How do ventures gain access to venture capital and business angels? And then we also talked about screening now. How do you actually evaluate what are the kind of portfolios you want to build? Obviously, this is just a short overview, but this is the best I could do in 3 hours. I hope you enjoyed it. A few people have asked me over the chat why I'm actually doing this, and I thought I briefly shared. I taught my my EMBA class, so I do this class is like for 5 days, where we go into detail, and I had a venture capitalist sitting in, and a very prominent venture capitalist, and I really tried to be like my very best teaching I ever did in my life. And afterwards, the venture capitalist came to me and said, like, this is an absolute scandal. And I was like terrified, and I was like, oh, I'm terribly sorry. I tried to do the very best I could. And he said, look, that's exactly the point. It's very evident that you have invested thousands of hours in preparing this material for these 5 days, and you teach every year 200 students. And he was absolutely right. In my typical year, I teach about 200 to 250 students, and I've invested thousands of hours into the material. So the very idea was just to share this, okay? So if you enjoyed it, if you learned something, this is the whole purpose. I don't have anything to sell. You don't need to buy a book. I have no book in the first place, okay? So I hope you enjoyed it. I might do some of these again in the future. I do not know yet. It's a little bit of work, I have to admit. I've done now 48 or 49 or something like this. Yeah, but I hope we actually see each other again. What has come out of for me personally has been great. I had a lot of people kind of reaching out for research purposes. I've started to work with some of people who have been on this call. So I hope very much it's the beginning of the conversation, not the end. This is very much it. I'm going to stay around a little bit for like questions and answers. So if you have like a question, please use the chat and I will try my best to answer your question. Otherwise, we're in the middle of a pandemic, so please take care of yourself. And if you can, take care of somebody else. Okay? On that note, I hope to see you again in the future and have a good weekend. It's Friday. The weekend is in front. All righty? Bye.
Thank you.
Thank you.
Thank you.
Thank you, Anna.
Very much.
Thank you.
Thank you, Mr.
Thank you very
Henning.
much. Thanks a lot.
Session.
Thank you.
Thank you very much.
Thank you.
Thank you. Thank you very much, everyone.
Thanks a lot. Thanks a lot.
Thank you very much,
Henning. Much
Bye-bye.
appreciated.
Thank you.
Indeed. Thanks.
Thank you. Bye-bye.
Thank you. Bye.
Thank you, everybody. Nice meeting you. Bye.
Nice to meet you. Bye.
Thank you. Bye.
Let me unshare
Thank you very
my
much for the
slides.
interesting seminar.
My pleasure. Then I have a bit more space here.
Thank you, bro. Very much. Bye.
Joe might ask, will you be willing to take part in a startup selection committee? I need a bit more context for this, Joe might. Maybe you can send me like an email about it. I've done these kind of things in the past, very limited so. My full-time job is to be a world-class researcher and a world-class teacher, and it takes all my attention to even come close to that. So I'm very, very careful with additional kind of commitments, but please feel free to kind of shoot me an email and I'm happy to say what I think. Please, when you send me questions, please do them publicly because it's very difficult to answer private questions publicly, okay? One of you asked privately, where do I think impact investment will be 5 years from now? Look, I think what we call impact investment will be more and more common investment. Here's the reason, or like, at least that's my hope. Here's my take on this. Imagine I come to you and say like, hey, I got a great idea how to produce like sport shoes. I can use child labor in China. You would be like, are you completely insane? And so you see, like, my hope is that what we now call impact will become more and more the norm, right? You see, take, for example, gasoline. If I can kind of pitch to you now a gasoline-based car manufacturer as a venture, you would say like, no, I don't want to invest in that because the world is moving in a different direction. So I believe that these kind of things we associate with impact investment will actually become more and more mainstream. And so you basically have no other choice than doing that, okay? Anna asked, could you please elaborate on the possibility of connecting with the people from the session? So I hope at some point to put like a community together. I need a little bit of time for that, but I hope over the summer to put like a community together so that you can continue to discuss with one another. Yeah. Tarin asked, are you going to do another one? So I do this session. I'm scheduled for 4 more of these. What means I'm scheduled? I'm scheduling myself. It's a one-man show thing. But sounds cool, like I'm scheduled for. No, I've scheduled 4 more. So I'm doing the same thing at least 4 more times. I think I will do a few more in the fall, but I'm not yet sure about it. And then I hope in the future to do webinars on other kinds of topics. Okay. Could you share the names of the companies for the investment case exercise? No, because I want it again, run it again in the next session. So I'm going to tell you at some point. Yeah, so Adam asked, I mentioned building a community. So I will at some point kind of put together like a software platform where you guys then can connect. Jessa, what is your advice for high-tech startups trying to find an investor? Look, Jessa, quite a bit the kind of things we've talked about today. Otherwise, it's highly specific to the venture. So it's usually like, it's a little bit difficult to give like a general advice. The better performing you are in your operational business, the better you are. But it's difficult to kind of give this very broad general advice. Okay. I want to develop a venture capitalist this year. Can I reach you? Feel free to send me an email. Yes. Could we get a list of all the participants to connect via LinkedIn? No, I would not do that just kind of to protect the privacy of people. You see, like, I'm happy to kind of create, like, I might create at some point like a LinkedIn group, but then it's really up for everyone whether they sign up or not. What I just want to avoid is that I think I'm not even allowed to share the data, to be honest. It's not so much a question of my preference. Yeah. I've already said something about evaluate impact investments. Yeah. What do you think about the use of data and AI in screening and adverse selection in VC? Artem, I'm very skeptical. I'm very skeptical on that, honestly. I'm not an expert on it, but I'm very skeptical. The reason for that is, you see, AI is really, really good in pattern recognition. But the key thing about startups, right, or the very successful startups, is that they actually do like really novel things, right? And so it's a little bit, you see, like just from my basic understanding, it would be very difficult to detect something truly novel. I'm not saying there are not ways to do it, okay? But I believe, and you see, like then there's so little data available in that early stage. So from that angle, I'm a bit skeptical. Yeah. Any thoughts on challenges related to investments in hardware startup in Europe? Oh, nothing specific. Look, hardware startups are always like super difficult. I'm encouraging. I would love to see more hardware startups in Europe. Yeah. Heiko asks, do you have a literature list or book recommendation for VC angel investments? That is something I hope to put together for when I kind of do the community thing. Look, I have studied this material now for like 15 years or so it's very difficult for me to pinpoint like to a single book or something like this, but I should put like a list together. Yeah. Elliot asked, why have M&As been increasing while IPOs been decreasing again? The main reason why M&As have been increasing is really that companies like Google and Microsoft and so on are very keen on buying young startups. So you see, take the example of Facebook and Instagram, right? Facebook realized, look, Instagram has two characteristics. A, they have a great team in place. And second, this could actually be a potential threat for us. And so why don't we buy this company, right? And now they bought it at the time for $1 billion, which in retrospect looks incredibly cheap. It looked expensive at the time, but in retrospect, it actually looks like an incredibly cheap deal. Right? If Instagram would be valued now at the stock exchange, it would probably be in the 50 or 100 billion range, or potentially even higher. It's one of the cash cows of Facebook at this point. So, and that is the reason they basically want to manage these competitive threats, and they want to get like these high-performing founder teams. Yeah. For impact investing, I want to maximize social ROI and minimize risk. That's opposite to what you taught today. I'm not sure. I didn't. You see, like, how so, Giori?
You said the type 1 error is minimizing the financial risk. That is not what a venture capitalist or an angel investor does. For impact investment, if my vision is to propose to millennials that this is a great thing to do and you will not lose your money. So you're saying the way to move forward in venture capitalism world is not to look at the risk. You are assuming you're going to bleed money and one venture is going to become successful.
So first of all, I'm not saying in which direction we are moving. As a scientist, I'm very good in predicting the past. Okay, so I'm not saying anything about the future. The way venture capitalists classically worked is that you have lost money on most of the ventures you invest in, but then you make money on a few. I can totally see that you get the same kind of result in with respect to social RI, right? You see, if I invest in 10 vaccines and 9 of those bomb, but one of them actually then cures malaria, or HIV, I've done fantastically well. So I'm hesitant that doesn't have to be a contradiction to me. It can be exactly the same approach in that sense. Yeah. Well, what do you think of venture debt for early stage startups? Mahmoud, that's a very, venture capital and venture debt is a very, very fuzzy boundary. From a purely legal standpoint, these contracts are typically structured as debt with an upside participation. So in that sense, I would not think of this as an alternative. When you raise venture capital, you're basically going into debt and you need to pay this back at some point, okay? If you're not making as much money, you see, like, what does not work is you raise like $1 million, then you give up 20% of your company, then your company becomes worth 500,000, and you say like, now I cash in the $1 million and you get like 100,000 or so. So you need to at least generate as much money as you got from the venture capitalist, okay? So the contracts are typically structured as debt with an upside. Have you done any research about the impact of venture capital investment in Africa in 10 years? Nobody, I've not. I know a few investors who invest very actively in Africa, but I've not done like formalized research on this. Christoph asked, why not becoming involved in politics? You mean me? Christoph still around?
Yes, you, because I think politics and business will be increasingly associated.
I'm actually, I'm a strong believer in politics. I think I don't have a good outlet. I don't have an automatic outlet to do it. If you kind of say like, join this committee or something like this, I'm all up for it. I have kind of studied for 15 years, giving up my professorship now to kind of run for election and being attacked by everyone. I'm like semi-keen on this, but I'm a full believer in kind of engaging in politics. So it's something I would love to. I'm not sure where the kind of research I do tends to be more on operational practices on how make startups or corporations better. But if there's any kind of ever like a good outlet where I can self-integrate myself, I'm happy to go along. Martin asked, could I create a book of all the contrarian ideas? You know what, Martin, I did not document them. I've started documenting them a little bit more. So I've thought about putting something together. Like, I'm not sure if it's enough for a book, but I thought about writing like a LinkedIn article or something like that. Yeah.
I think it's really interesting, the list.
I'm totally fascinated. I'm totally fascinated by it. I thought about.
So I think you should really try to keep a track of that, because
Okay. All right. I'll keep it up. I'll keep it up and I'll keep track. Okay. A non-high-tech startup doomed to have little access to VC funding. Luis, in the past, it has looked a little bit like this, right? Most of the financing is high-tech because you need stuff which scales. Having said this, you see companies like Starbucks or so have done extraordinarily well. So I think, look, there's going to be a focus on high-tech, but it doesn't have to be exclusive. If I have any advice regarding incentivizing advisors, Damien, it's actually a very good question. There are a lot of people who want to provide advice, but who are not necessarily good in providing advice and are not always kind of incentivized well to do it. I think the biggest effect is honestly in selection. I think we very often talk about incentivizing people, and where it's actually like a selection effect. So I give you an example, okay, of my salary, and the same is true for my colleagues. About 2 or 3% is bonus, okay. So it's a complete joke compared to what you would see like in an investment bank, where like 50% or something is bonus. But I would say we are so careful in picking up people who are intrinsically motivated to kind of bang their head around against the wall for 16 hours a day to do good research. So in that sense, our effect is more like, so I often feel like people think a lot about incentives, and you see in a lot of profession, if you're a car dealership, you should pay attention to incentives all the time. But when you think about advisors, I would focus quite a bit on selection. Let me put it this way. It's very difficult to fix something with incentives, which you got wrong in the selection when you hire an advisor. And then you see, and then the way I think about it is, but this is my personal take. So I can tell you this from my personal kind of standing. I sometimes get asked to be like an advisor on a startup or like on a corporate board or something like this. And then I would say, like, look, now I also want to be paid decently for the very simple reason. If you want me to engage, then you should also, like, you really want to be involved. And then I want to participate in the success of the company if I actually get involved. If you do not want to deeply get me involved, then don't kind of include me in that, right? So it's a little bit of I think we over-focus a little bit on this, like one specific number, but think about more what the role of the person is going to be. Who do you want to pick about this? It's too often like a random encounter where somebody says like, hey, I could give some advice and now you need to provide some incentive. And these, I don't have good experience with those. VC is a content game. What are your thoughts about cross-border VC investments? Do you see that growing? My understanding of the data is that it is indeed growing, but what happens is that these companies basically then create local bases. For example, Sequoia China is very, very strong, but that is really then a local game, right? So it's not as if somebody in Sequoia Palo Alto would say like, we invest in this Chinese venture now. Bart, is it better to invest in 100 ventures instead of 30 to increase the chance of hitting 100 times or 1,000 times X venture, or better than going after deals you have a high conviction of? Look, this is a trade-off, Bart. I think what you really need to do is to understand these trade-offs in detail. my philosophy in life and investment philosophy is always like, I'm very keen on investing in things in which I can be personally involved. So there's nothing I invest more in than in my personal career. So if I invest in like 100 ventures, I would be like, I have so little control of it. I'd rather feel comfortable than putting it into an index fund. Or like, if you have the money to invest in like 100 ventures, I would be like, look, why don't you give it to the pros and give it to like Greylock, Andreessen Horowitz or something like this. So my tendency would be like, I want to be involved in this. I want to kind of make a difference then in that moment. So I would err on the side of 30 rather than 100 or like 10, 15. That would be my personal take on it. Marcel, what do you think about decentralized finance, blockchain-based platforms facilitating similar principles as bank? Marcel, this sounds horrible. I'm too old for this shit. No. So what I mean by this is like, I'm half joking. It doesn't come totally natural to me, okay? And I haven't made I did not yet study it in detail. I probably should. But my life is kind of busy just understanding what kind of keeps on going in like traditional entrepreneurship, traditional finance. So look, I've already said 150% of what I know about it. I would need to look at the very specific use case of that. JD, will we get the results of the exercise today? Yes, give me a few weeks. This is some part of what I said in the very beginning. I had expected to have 400 or 500 people, and now I got like 11,000. So I'm a little bit behind on my emails and stuff. But you'll get it. I hope it's weeks, not month. It could be month, but you'll get it eventually. Okay. Yeah, Adam asked, what do you think of venture debt? I think I mentioned venture debt is basically venture capital is classically venture debt, because you see, like the way a VC deal is structured, they give you $1 million and then say like, now you owe us $1 million. But beyond the $1 million, we also get 20% of the company. So you always, every time you take venture capital, you basically take venture debt. What do you think about startups that ask for your investment and ask you to be an advisor? Look, nothing wrong with that. Nothing. Look, I think it's good when people ask. But I think you should also be very comfortable to say no. I get asked for, you see, like I probably get asked at this point to kind of invest in stuff like on a weekly basis. And my answer is basically almost always no, because I do research and teaching. I'm not an investor. And I have no time to I would not have time to work with them. But you see, like if you want to be an investor, great if somebody asks you, right? What is your advice to gaming startups that are looking to raise funds? As per my experience, I've seen gaming companies attract less VC investment due to a hit-driven market. So Aditya, this is right. I've actually talked with a very prominent VC, Heidi Rosen, about this very question. It's a market which is, look, first of all, there is basically something like venture capitalists in that industry already, and those are video game publishers. Video game publishers are basically operating like venture capitalists, but have more industry knowledge and have more of the infrastructure to actually foster these kind of ventures. And in that sense, there's actually very little space for venture capitalists. Okay. And then, so I did my dissertation on video games. So in that sense, finally, something I actually know something about. You need a lot of expertise in actually getting a game to work. And it's unclear whether there's room between the developer and the publisher that on top a venture capitalist engages. And then you see venture capitalists are very keen basically on getting companies which are ready to exit at some point, right? But to be ready for exit, to have an exit, what you need to have is a continuous revenue stream. And as you've already pointed out, this is a completely hit-driven business. So it doesn't lend itself to like classical kind of going public. Companies like EA have obviously managed to have such a scale that they are able to kind of have hit after hit, and so it smooths itself out a little bit. So you're also right. I'm also planning to indulge into research when it comes to startup. The words indulgent research don't go well together, I will say, but sure. I'm planning to indulge into research where I'm trying to look at the utility of AI in startups. Would you mind looking at the research proposal? Feel free to send it over. I might say no. I'm kind of busy, but yeah, feel free to kind of give it a try. You have to think about it this way. I'm sorry if I'm sounded like somebody who pushes a lot back, but imagine like out of 11,000 people, 10% send me an email and ask me to look at the investment proposal, which, by the way, is a pretty accurate guess of what's happening. I've probably gotten 1,000 business plans in the last 6 months. So there's just a limit in how much I can engage with business plans. Okay. But I must have, what do you think of eFounders approach? You need to tell me what that approach actually is. I actually don't know the eFounders approach.
No. It's interesting because they started 10 years ago and they only launched 30 startups. So pretty limited number of companies. Okay. So it's exactly, so they seem to be pretty focused because I think 10 years.
I don't know it. I don't know it. Can't say anything intelligent about it. Alrighty, I'll do one more question and then I need to jump. What cities, countries offer the best environment to find good money in venture capital? Christoph, this would be a question I would say, don't be focused on that. Look, if you ask me that question in isolation, which country offers the most access to venture capital? Silicon Valley. Okay, it's very easy, Palo Alto. But here's the thing. Try to hire in Palo Alto a software engineer for less than $150,000 and you have absolutely no shot. Okay? The prices so you get much more money in Silicon Valley, but the prices are also so off the charts that you kind of cannot believe it. I remember this, a close friend of mine started this is a conversation, it's 4 or 5 years ago, and he got a job in Silicon Valley and he earned $200,000. And I said, that's incredible. And he said, yeah, that's incredible. I don't have enough money to send my kids to school because the school fee is $30,000 and I have 2 kids. And now I don't have enough money basically to buy rent for a car and I haven't yet eaten a single banana. So it's really relative, so to speak. So I would look, this is at this point quite a global industry. I would focus on the operational business and then I would pinpoint to I would say look, which kind of investors are a good fit for me, but not think too much in terms of regions. Okay, this is a little bit, I often talk when I teach my MBA class about this. Look, I'm not saying that certain environments are not better than others. Look, I'm in a profession which is 100% in English, okay? As a non-native speaker, I'm obviously at a disadvantage for that, right? But here's the thing, what should I do about it? You see, now I actually study a lot of kind of more European or global things like Formula One. And so I find my own competitive advantage then with the very specific set of assets I bring. So in that sense, I would not worry all that much about the specific environment. I would look for what is a good fit for your specific venture, okay? That is how I would think about it. Alrighty, on that note, as I said before, take care of yourself, and if you can, take care of somebody else. I would love to be in contact. I hope to see you again in the future webinar or so. Alrighty? On that note, bye.
Thank you. Amazing session.
Thanks again.
Thank you.
Bye-bye. Thanks.